Hit it. I guess we're now ready.
Oh, my turn?
Okay, let's just hit it.
It's Friday, July 1st, 2022, episode 185. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, Patrick Ceresna gets replaced as Kevin's favorite technician as Carter Worth joins us to tell us about his methodology for analyzing markets, how he is worried about the coming fallow period, and why gold is something that all investors should consider. Then Harris is back for a Kuppy's Corner you don't want to miss. And if that wasn't enough, then Patrick pulls the crayons he is chewing out of his mouth long enough to give us a terrific talking chart segment.
You do realize you said methodology instead of methodology. No, that's perfect. Keep it in. I think that's great, Kev.
Okay, let's just keep going.
We're going to end with our segments of No Stupid Questions and Skin in the Game. And, well, folks, we might even drink some beers along the way. So stick around. We got a great show. Lena, hop on. What beer are we drinking on Canada Day?
So for Canada Day.
That's right, actually.
Go ahead, Kevin.
That's right. Happy Canada Day for everyone, all the Canadians that are tuning in. I hope you're enjoying it by the dock.
Yeah. And by the way, like we should have had Labatt 50 as the
we should have. We kind of messed up.
Labatt Saint-Con.
Well, we have a Manitoulin beer brewery, which Manitoulin Island is an island way up there on Lake Huron, which is terrific. So I think this is representative of Canada.
It's called Odaemin Strawberry Beer. And I was trying to look for this description of the beer. I cannot find any description of the beer anywhere.
Okay. Well, I have a confession to make. Well, while we're trying this beer, I have to make a confession. All right. So, Kev, when you gave me these beers, when I got back to the condo, I was in the parking garage downstairs, and the paper bag ripped, and the cans went spilling, and this one exploded and basically started spraying everywhere. So I shotgunned it right there that day. So I totally do know what a foaming version of this beer tastes like. So I'll be happy to rate it. But I'm actually just going to have a Corona right now.
Odaemin apparently means strawberry in Ojibwe.
You know what? If you told me strawberry beer after the disastrous blueberry beer that we had, even though it was from Lake of the Woods, my home area, This isn't anywhere near as bad as
I thought it was. This is more a beer than.
It's sort of like having a rosé in the summer. It's like if it wasn't the summer, it would.
A rosé they use shotgun. All right, let me do the side effects. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much Huddle may include the James German Boons, No Time to Buy. Dr. Copper in the Multiverse of Sadness, and Stop Gun, Run Like a Maverick. Big thanks to Vipul that the guy sent us those. I like those.
That's awesome. All right. Let's get to our first guest.
It's our great pleasure to welcome to the show today Carter Worth from Worth Charting. Carter, thanks for joining us.
What a pleasure. Thank you for having me.
It's a great, for those who don't know, you've often seen Carter on CNBC. He's a staple of the technical analysis, the dark art, as I like to call it. But before we get into what you're thinking about the markets right now, I was wondering if we could go through how you got into the business and how you got into the technical analysis side. Let's just start off with, when you were going to university, did you think you wanted to be on Wall Street?
Well, I did grow up in Manhattan, and it is the cottage industry of New York City, right? Wall Street being either the biggest employer, second biggest employer, almost year after year, with the exception of healthcare, big hospitals, of course. But maybe I can just answer it in the most direct way possible. The truth is, I went to Wall Street because I have no natural God-given talents. and this is obvious and elemental, and I think everyone in their most candid moment would or should know that, in the sense that if I could swing the golf club like Tiger Woods, I would have done that. If I could sing like Mick Jagger, I would have done that. If I could act like Tom Hanks, I would have done that. But I don't have any of those God-given talents, and so it doesn't take much sleuthing or figuring to notice that the margins in Wall Street are exceedingly high, right? Great fortunes are made, and the pay is basically outsized. You can be, for instance, the star at your high school, the valedictorian college, your MBA from Harvard, and you can end up at a massive company like Johnson & Johnson, maybe head of all North America consumer products, from Band-Aids or Q-tips or whatever it might be, and you get paid handsomely, but an average guy on Wall Street makes 10 times. And so
Yeah.
just to be very frank, it's a bizarre thing. We see this in all of life. Why do teachers get paid so de minimisly when they're doing such an important role? Or again, a nurse. But the point is, just sheer human interest, greed, whatever you might call it. I went to Wall Street because it wasn't missed on me that there was money to be made.
All right. So you now what was your first job? How did you start? Like, how did you get that first opportunity?
Yeah, well, I came out of college, Boston University, and I always thought I wanted to be in advertising. And I, in fact, had a small publishing company that was going to move in that direction. It was about not so much the content, but it was more marketing / publishing and getting sponsors and ad placement. And sometimes they say the best investments are the ones you never make. It was clear after about 9 months that you could put more money into this, maybe not get it out, but I should basically not proceed. And I ended up, I went out just to clear my head. I was driving a tractor on a farm out in Long Island for about 6 months. And then I said, all right, I've got to get serious here. So I answered a help wanted in the New York Times. And it was for securities an analyst. And it was at a company called Value Line, which everyone knows. They're the originators of the one-page research report, which Standard & Poor's also did in the 30s. Morningstar does now. And so I went in for this interview. It was probably 50, 60 people. And they gave us we had all of a sudden, we sat down and we gave us an exam of sorts. The first was, it was 30 math questions in 30 minutes or 20 minutes. They had 40. It was like, little stuff. And then they took the paper away, and then you had to write an essay on the U.S. economy. And then there was a third, but there was one longer math. It was like, there's a plate of steel that's 4 feet by 4 feet, 6 inches, in depth. If you cut a circle out of it, what's the volume? And I could never do that now, but I guess I could do that at the time. And so this quick math questions, one longer math question, and then you write an essay. And I actually remember I started, this was 1989. And anyway, I got a call, and when I returned, there weren't 60 people in the room. There was just me.
Oh.
They said, well, we like the way you write, and you did fine on the math. And so I started at Value Line as a securities analyst. And
just to be clear, this is a fundamental securities analyst.
Yeah, sure, exactly. And because no one really starts as a technician, because there's nothing in that era where there were no training programs. You don't, no one hires you as a junior to start looking at charts per se, although it's obviously been going on for hundreds of years. And so what they do when you're young is they don't give you the big companies. Like, so for instance, the most oddball things they hand off to these young people who are 20, 22, whatever it might be. And so the very first area I was assigned was specialty finance. Now think about that. So that's not covering a big bank like JP Morgan, right? Or Citibank or Manufactured Hanover at the time. It's not covering American Express, right? It's not covering an insurance company. It's things that they had no category for. H&R Block. Like, what is that? Is that finance? Or there was household finance, which is almost a predatory lender, beneficial, right? Where you have rates at 30, 40%. And so I covered specialty finance. And then at one point they shifted me to specialty steel, which means they're not going to give the U.S. Steel to the junior analyst, or Inland Steel, or Bethlehem Steel. So you had this little thing called Carpenter. Stainless steel was just coming on. Carpenter Technologies, Allegheny Technologies, and ultimately oil and gas, Canadian oil and gas, of course not. But I was there for a year, and I got a call that basically changed my life, and so then I went on to that opportunity.
So what was the call that changed your life?
So I was at my desk, and someone named Eric T. Miller, who was the chief investment officer at Donaldson, Lufkin, and Genrat, basically the preeminent white shoe firm on the street, up there with one or two others, but a boutique. And not only was he the chief investment officer. He was the chairman of the investment policy committee, the chairman of the stock selection committee, and he hired me. He also said, I like the way you write. And I started working for him. And it was there within the portfolio strategy group that I met my teacher and mentor. And his name was Vincent Boning. And he had started in the Fidelity chart room in the 1960s.
Whoa. So Fidelity had a chart room back then? Like this is Fidelity,
sure.
the mutual
Fund?
fund?
One of the original charts. The chart room is famous. It's the size of not quite an airplane hangar, but it's big. And the Johnson family originally was a big user of charts, and many people. It's a sight to behold. The Fidelity chart room is epic. And
wow, I had no idea. And so they were doing. Were they almost at the forefront of technical analysis? Was anyone else doing it back then?
Oh yeah, I mean it's always been right. They've got candlestick charts going back over 100 years. But interestingly, just about the mentor, which I think is not necessarily unique to me, but very important. If you think about the first person to construct an index, we know who it was, right? It was Charles Dow. And Dow theory, which was developed by some of the other editors at the Wall Street Journal, the founding publication that he was a part of. He started with his customer afternoon letter. And he was from Springfield, Massachusetts, had been a journalist. And the seminal work on the subject of technical analysis is something known as Edwards and McGee. Just as in fundamental land, people don't refer to the title, they say Graham and Dodd.
Right. Okay.
Graham and Dodd, and it's the same thing in technicals. The seminal works, the only book I've ever read, is known as I think it's Technical Analysis of Stock Trends. It was first edition 1948. But the point I'm making is it's referred to as Edwards and McGee. And here's the thing: Charles Dow was from Springfield, Mass, and Edwards and McGee operated out of Springfield, Mass, and have a link to Charles Dow. And my teacher and mentor knew Edwards and McGee and was from Springfield, Mass. So literally a line that connects from Charles Dow to his apprentice.
Wow. And so this guy took you under his wing, and you started to shift from being focused on the fundamentals to the technicals?
No, I'll tell you why. Here, it wasn't shift. I was about to quit.
Okay.
I got out of Value Line because I didn't like and let me just make that point because it's very important. And that's why I refer to them as the fundamentals. The error rate predicting quarterly results is nothing short of preposterous. Everybody knows this, right? So the analyst thinks it's going to be $4. It comes in at $2. What? How does that work? I mean, it's supposed to be that, and forget about something that's opaque and hard, but let's take an operating business like a store, Gap stores. You know how many stores they have. You can study consumer trends, disposable income. You can study inflation, cost of goods sold, all of the things. And yet analyst community and myself, I'd have these horrible estimates that would never be right. And it's gotten worse on Wall Street than it was then because there's no whisper number prior. But there's also this. When we were building out the spreadsheets, you would talk to the IR department, which still goes on, and you would say, well, I'm thinking it's going to be $1.20 for the quarter, built my model. And you have these long models that would start with revenue, and then you'd have operating margins, and you'd work down through and you'd get your EPS figure. And then they might say, well, I think it might be a little low. But they're not going to tell you what they're going to earn, right? But you're there at $1.20, and there were just 4 levers you could pull every time. And so I was thinking maybe I'm low, he won't go. So the first thing is revenue growth, just the top line. I've got it modeled at 7%, so I put it up to 7.5, just like that. Of all the columns and rows, and all of a sudden my EPS went from 120 to 122. I got 2 cents right there. And then the gross margin. I mean, who knows? What's the gross margin? Company doesn't know. It comes in a little. And so I had my gross margin and I'd move that. And all of a sudden I was up to $1.25. And then the third thing, of course, is shares outstanding. They're always issuing shares and buying back shares, and you're never quite sure what the count will be from company stock. And so I changed that a little bit. And then I would be up to $1.27. And then there was tax rate. Every quarter, the tax rate. It's always changing. And I got it, $1.30. I just went from $1.20 to $1.30. So here's the thing, and this everyone should know this, and everyone does this. Wall Street math is no good. Real math is the end. Here, I'm sitting in a building, I'm on the 15th floor. It never once occurred to me this building will collapse. Because the math was good. The math of the engineer is good math. Wall Street math is terrible. And that's why I got out of it. And so this teacher and mentor, I was about to quit. I was looking at the LSAT books and the MCAT, going to be a banker, lawyer, doctor. Okay, got to get out of the banker thing. So let's get into the lawyer or doctor thing. And I met Vince Berning. He's a German. All four of his grandparents born in Germany. And he said, let me show you a thing or two. And I was struck on the spot. Changed my life.
Okay, so what did he show you?
Well, he showed me that all of that other stuff I knew already, but he showed me how silly it all was. And what he basically imparted to me is the importance of price volume correlation. But what I would really say is that it gets down to this. One either accepts or doesn't accept the concept that there's wisdom in price. Now, the government knows it. The government includes stock prices in their leading indicator index. They know it. Right? In fact, the Fed is very worried about the market all the time. They'll target the market. Some people think they manipulate it through the plunge protection because it's the greatest leading indicator of all. And so what he basically, and I spent, years learning at his knee, was trying to recognize the patterns that repeat in the market. And I would go so far as to say that any decision that anyone has ever made in their life that was really true and good and accurate, it's based on pattern recognition. And so let's just use a few very pedestrian examples to make that point. So right now I'm sitting in my office in New York City, and if there were woofers and electric guitars and speakers and other musical equipment being charged on my credit card, my American Express right now in Boston, let's say, you know what would happen? The computer would block the charge. Now, I have a sibling that's a big musician, right? Plays all the time. Even then, they're like, well, yeah, but he lives in Chicago. He maybe buys equipment around in Boston. It might go through. But I not only have nothing to do with music other than I appreciate and listen to it all the time, I certainly don't play it and have any. So the computer is engaging in one thing only, pattern recognition. It say, this is off pattern, block that charge. Okay. What does the scientist, a bench chemist at DuPont, or hundreds in a row, working all day, 8 hours a day, staring into the microscope. And one day in the Petrus, eureka, we've got it. It's right there. They're studying, nothing happens, and one day, or the fundamental analysis. Why are same store sales so much different the past week? Why is the average receipt so much higher, right? Why is debt or accounts receivable starting to increase? We study patterns on the balance sheet as a fundamentalist, patterns in consumer trends, whether it's patterns on the charging on the credit card or in the Petrus, or the best example of all, and this is very elemental. Look, do you know what happens at 5:15 every night? I mean, this is literally like clockwork. Maybe 5:20. My wife comes through the front door. Now, if my wife comes home at 3 a.m, I got a big problem. I mean, she's taken up with an old boyfriend on Facebook. This is elemental. And I'll give you one more just to make a point. And this is what, so pattern recognition is what he was trying to impart to me. But this is actually the most part. I had an associate, an admin type, who, and we start every day at 7, right? And every day at 7:01, she walked in to the front door. She was tremendous. Now, if you live 45 minutes away, Staten Island, taking public transportation, we all know it is mathematically impossible to be on time, the same time every day. So someone who was very careful would obviously be early, not to have delay. And then she must have waited at a coffee shop or sat out if it was nice weather, and then would ascend and come up into the office. Same time, like clockwork. Okay. Now, worked together for years. And one day, 9:05, 9:20, she walks in. Now, I'm not a hard, I didn't say a word. Good morning. How are you? And we got to work. And then the next day, 7 o'clock. And then about a week later, 10:05. And then 7 o'clock. And then 2 days in a row, 8:30. Now, you don't need to know anything more. You need to know whether you know that a child is terribly sick, like it's life or death, or something very wrong in the marriage, or she herself has a physical condition, or she's caring for something. And guess what? I said, is there anything I can do to help in any way without even knowing? And then she said, well, this is what's happening. This is what's going on in my life. Pattern recognition, whether it's your spouse or your significant other coming in at 3 a.m, you've got to be aware of that. Or whether, why am I getting strange charges on my credit card? And so pattern recognition in the market, this is the most important thing, is the study of volume, unusual activity. It's basic, it's elemental, right? And so the existentialists would say existence precedes essence, a Camus or a Sartre, and in markets, volume precedes price. We're looking for tells, unusual activity. Why is this trading 3 times average? And if you look and then you say, oh, well, it was upgraded by Morgan Stanley. Okay, that would explain it. Or why is this stock up 10% on double the average daily volume? It's only 12 noon, but there's no news. There wasn't an article in Barron's. There was no upgrade by Morgan Stanley. There's no news at all. Then it's only one thing: someone expressing a view with confidence. Is it George Soros? Is it Fidelity? Is it 2 people or 4 funds working together? We're looking for unusual volume spikes that move the price, that then are tip-offs to something that's coming. And more often than not, someone is ahead of the news, whether it's an FDA approval or an earnings beat or what have you.
So that's a great story. And I was gonna say, when you were talking about your associate there that was coming in late, we always on the desk, we used to have the joke about the interview suit. When all of a sudden the guys someone would show up in a little bit crisper suit with a tie, and we were like, interview and stuff. So that was immediately what popped into my head when I thought that. But I might be a little cynical, but that again is a pattern recognition. Okay, so let's go and just talk about this, the way you approach technical analysis, and the fact that you say that volume is the important part, but you also mentioned the fact that if there is something to explain the volume, it doesn't mean as much. Am I reading that right? Meaning that if you
because why would let's walk through. If we have a $20 stock, right, and average daily volume is 1 million, on any given day it trades to $20.20, and that closes 1.1 million shares. Next day it's down to $19.90 on 1.2 million shares. Then it closed the next day at 20 on 1 million shares. That's basic equilibrium. Okay. Now, you've never heard it, but if stock XYZ had perfect equilibrium today, no shares traded. I'm not talking about a thin little micro, but a real stock, 10 billion market cap. It's impossible. It's mathematically impossible. A stock that has 1 million shares every day on average can't have no volume. That would be perfect equilibrium, which is to say, if the highest bid is $19.95 and the lowest offer is 20, but nobody budges, or spread by a nickel, nobody reaches, then we would have volume 0, stocks closed, perfect equilibrium. Okay. So take that. The reason why that doesn't happen is because on any given day, there are people that basically have to act. So this is a stock, again, call it $20 stock, hypothetical, that trades 1 million shares on average. If the best bid's $19.95 and the best offer is 20 and nobody moves, that's perfect equilibrium, volume 0. But what happens is, of course, so the lawyer's coming into the market, the dead person's dead. He's settling the estate. He's going through the stocks, and he's like, all right, well, we're selling this one. What's the best bid on this one? Okay, it's $19.95. He reaches down and breaks the equilibrium. He sold, you would agree, and reach and hit the bid. And so all of a sudden, shares are traded. And then there's a new manager coming into the market, and he's been allocated, and he's trying to put money to work, and he's got to get it done. And he's like, and he reaches up and he pays 20. And any given day, that goes on. There are people that are moving around, they're just trimming positions. But what we're looking for is something different. So the hack observer says, well, you say a heavy volume day, but on every share, there's a buyer and seller. Why does the volume get assigned to be bullish or bearish? That's just not understanding how markets work. Okay, so here we go. The way markets work is as simple as this. It's not because Carter says so. It's that every great trader knows this, sitting on, whether you're sitting in the pits in Chicago or you're standing on a trading desk at a bulge bracket. That $20 stock that has equilibrium because people are just buying and selling because someone's settling the estate and someone's putting new money to work. But what we're looking for is the following. Bell goes off. It's $9.95 by 20. And all of a sudden, trades 1 million shares a day on average. And right away, the stock's going off at 20, getting filled. All of a sudden, 50,000, 75,000. It's only 935, 940. It's traded 100,000 shares. It's 950, 20 minutes into the day. And it's already 20 2005. Now people are like, what happens? It's just like anything else. They're like, wow, there's a big buyer in the market. I mean, someone just keeps, so they lift the offers, right? The offers are lifted. Now it's 2050, let's say. And all of a sudden, another 25,000 go off at 2050. So now the stock's up from 20, the prior day's closed at 2050, and 150,000 shares have traded. It's only 11 o'clock and trades $1 million a day. And then people are like, wow, there's someone just paid 2050. They lift the offers again. Now it's, let's say it's 2075. And all of a sudden, right away, there's another 25,000 filled at 2075. And all of a sudden, then, wow, there's a big buyer. And now let's say it's 21, offered at 21, best bid 2075, and someone pays 21. Now all of a sudden, here we are, it's 11:30, and 600,000 shares have gone. Stock's trading at 21, up substantially. Yes? Up.
Yeah.
Okay. Now, you could say they're buyers and sellers, but someone is breaking the equilibrium. So keep going. So now all of a sudden, it's 1 o'clock. It's trading at 21. Now, if there was a big buyer who really wanted to get into a position, what do you have to do to get it? You have to keep moving the stock, don't you? That's the definition of expressing a view. And so what we're seeing here in this instance, right? The stock's up 5% and it's 21 and then all of a sudden another 200,000 shares. Now it's 130 and 900,000 shares are on their tape. The stock's trading at 21.50. So let's personify this. Here we go. And then I'm going to try to tie this all together. This will make sense. Start of the day, it's 9:40. In all my life, I've seen this at Lehman Brothers, at DLJ, at Oppenheimer. Phone call comes into the desk to the traders, right? 20, 30 men and women on the desk, and the PM's on the phone. It's always just before the open. And he says, "Hey, Roger. Hey, what's up, Tom? He says, I want to take a look at stock XYZ. This is the $20 stock we were just talking about." And he says, "Okay, what are you thinking? I want to do 700, 800 million. Do it. Let's do 800,000 share." And the trader right away, it's 927, 920. He goes, "Oh, wait. He goes, it trades $1 million a day. You want to do 800, 900,000 shares a day?" He said, he sort of annoyed the PM, says, "You heard what I said." And he said, "Aren't we, hold on, where are you going? Are we playing golf?" "I don't want to talk about the golf. Yes, we're playing golf on Wednesday. Get in motion." So the traders, that's his job. He gets in motion. He's trading and he's filled. And all of a sudden, as I described it, he calls the guy back around. He's getting filled. He's getting there. And he calls him at 1:30. He called him at 10. He said, "There's another 75." He calls him at 1:30. "Hey, listen, Ian, it's 21.50 last. We were only filled on 600,000. People obviously where there's a big buyer. Aren't you sensitive to price? I mean, do you want me to work the VWAP? I mean, I could get you another, buy it." Now, why would someone do that? So insensitivity to price is confidence. So let's talk about that. Either he's drunk, lost his mind, he's having Alzheimer's moment, or he's expressing confidence. When you're insensitive to price, what it means, and it's as simple as this, is you know something or you think you know something. And so the day goes on, it's 3:30. He said, he calls him one more time. He said, you only 700,000. He said, "Fine, I get you another 100. It's going to print 22.25. He said, "Do it." Okay. So now the day is closed. Instead of 20, 19, 50, 20, it trades at 22.25 and 3 million shares are on the tape. Okay. Now there's no news, no Barron's article, no analysts upgrade or downgrade, no information from the company. So I've personified this. It's not only one player. Sometimes it's other players, but the person who says the volume, they're buyers and sellers on every side, doesn't understand how markets work. The volume is assigned to the person that keeps breaking the equilibrium. That one buyer, was it George Soros, right? Was it Druckenmiller? Was it Louis Bacon? Was it one of the market grades? Or was it just a sort of a mid-cap TMT guy who was very confident about this position? And so what we're looking for is insensitivity to price. And what I mean by that is, we never go into the car dealership and say, "What's the ticker? 45? I'll give you 50, round it up." People don't do that. Buying a necklace for a spouse. "Hey, it's $800. I'll give you 1,000. We're looking for, why would someone pay up? Or when you see it on the way down, when people are pressing, trying to get out of a stock, it's because they've done better Qs and Ks, better channel checks, better due diligence, and this PM has figured out that earnings next week is really going to be good. And so there's no such thing as smart money. That's an offensive phrase, right? What, Fidelity's smarter than Wellington? Wellington's smarter than T. Rowe smarter than BlackRock? No. On any given position, there's someone who's closest. One man, one woman, or a team of people, and they've got it dead to rights. And when you're very, very confident, you're insensitive to price. You want to get in or get out. And there's two ways you get confident. 99% of the time, it's better Q's and K's, better channel checks, better due diligence. And 1% of the time, someone cheating. There's a lot of people who get information and the government's looking for it all the time. And so when we have that, and 2 days later, this happens all my life, the stock reports earnings or FDA approval, and it's printing 30 at the open, but there's fingerprints left behind. And so pattern recognition is it's like dusting for fingerprints. Who was this? We'll never know. But someone was here expressing a view, a very confident view.
Well, that's fascinating. Now, you have the ability to go through your charts and share the screen with us. So why don't we kind of jump through it here and get, let's test for some fingerprints in the markets that we're experiencing right now.
Sure. Yeah, we do some top-down. I wear my glasses. Here we go. So let's do that. And so I thought what we could do is look at their sequencing is very important in pattern recognition. So let's do the sequencing in the market, both sort of short-term, intermediate term over the last several years, and then really long-term. And so with that, let's talk about first the importance of market internals and what is technicals in that sense. So I'm going to add some columns, December 15th, March 13th, May 12th, and then June 14th. Okay, so here we go. On December 15th, we know that the S&P peaked on January 4th. But equities basically peaked 7 to 8 months prior. We know the MSCI All Country World Index, ex-US stocks, peaked 14 months ago. We know the World Transportation Index also, to classic Dow theory. But if you were simply just to look at the Russell 3000, which is the broadest aggregate in the United States, representing 98% of the investable capital, on December 15th, remember, the market goes on to make a new high on Jan 4. But on December 15th, the market was down a mere 3.4%. But that's the weak form of analysis, looking at a chart of the market. The principle is the parts compose the whole comprises the parts. Despite being down a mere 3.4% and going on to make new highs, look at the internals. The index itself is down 3.4, but look at this third row. 52% of the stocks were down 20. That's incredible. In fact, this was published at the time because it was saying this is a big problem. Internally, here's how I'd say, looking at a chart of the market is like you walk in a doctor and he stands 8 feet away and says, yeah, I think he looks okay. Like for me, I look okay, right? you have no idea whether I have gout or not, diabetes, you don't know what my blood pressure is. You don't know anything. I mean, the point is, that's how we don't judge a book by its cover. We get under the hood in the car. And so the weak form of analysis is looking at the index as determined here. The index is down 3.4. It actually went on, but internally, 76% of the constituents were already down 10%. 62 were down 15. I mean, think of this. 35% were already down 30%. So it was all coming apart, but it wasn't seen by the investment community. And then we go to March. Now it's starting to come apart, but look how much worse. The index itself is down only 13. At that point, 50% of all stocks are down 30, and you fast forward. The point is the internals led. And so it's no different than you said, well, what's the average grade in the class? That means nothing. There could be someone who's pulling. Or for instance, we all went to a sporting event. I came late, right? Hockey, basketball, whatever. And I looked at the scoreboard and I said, wow, we're doing great. And everyone turned to me and said, no, we're getting killed. He said, what do you mean? We're winning. He said, no, actually, so-and-so's hurt, he's out. So-and-so's has a terrible night. And LeBron James is carrying the whole thing. The point is, this was masked, but anyone who was doing their work, looking at the constituents, knew that we were in the process of coming apart. Now, of course, we've come apart, and now everyone's gotten bearish when that was something to do 6 and 8 months ago. So anyway, that's very important. Let's talk about sequencing. We've had 4 distinct sell-offs and rebounds since the Jan 4th high. See them here, 4 tables. Let's look at them. Jan 4 high, 1, 2, 3, 4. And then 4 distinct rebounds, 1, 2, 3, 4. So let's play the movie. Here we go. Our first drawdown, Jan 4, we dropped 12.4%, and then we ricochet, 8.8. And then we drop 10.5, and then we ricochet, 12.7. And then we drop 17.8, and then we ricochet 9.6, then we drop 12.9, and we've just ricocheted 7. So the point of sequencing is that any good uptrend, people love the word, they say buy the dip. What is a dip? It's a counter trend move. When you're ascending, all uptrends are defined by, punctuated by, counter trend moves, i.e., periods where it goes down, corrects, dips. Well, the reciprocal is, of course, the same. When you're in a downtrend, you have counter trend moves, rallies. Enron had 5, 7, maybe 20, 30% rallies on the way to zero, right? You always have counter trends, whether you're not. So we're in a downtrend, that's elemental. And we try to, if we're doing short-term work, time the sequencing. In terms of intermediate term, and this is the entire 2009, 2022 bull market, we've touched to the penny the midpoint. My own hunch is that ultimately we work into not only the lower band, but prospectively to the bottom end of the lower band, which gets you into the 32, 3300s. But let's look at really long cycle, and then maybe gold or one other thing, and we could quit or go anywhere you'd like. No drawings, no annotations. Now watch this. There's the 87 crash, right? Take it away, put it back. Take it away, put it back. Let's say you were so fortunate, dumb luck or brilliance, the most hapless E-Trader, Ameritrader, or George Soros himself, to have bought on the low that week after the 19th, the crash, October 19, 1987. And equally genius to have sold in March 30 of 2000. So you bought on the low and sold at the top. And then you did it again. On the low in 09, you bought March 6, 2009, on the financial crisis low, and you sold on Jan 4 of this year, 2022. Ready? Watch this. Do those look identical? This is the absolute low of 1987 to the absolute peak of March of 2000. And this is the absolute low of 09 to the peak. Are they identical? They're identical. 12 and a half years, 12 and a half years. How about magnitude? This was 617. This is 621. So there are cycles. We know their daily cycles. We know their circadian. We know their monthly cycles and the moon. Some people believe in biblical cycles. But the point is, this is a very clear cycle by my work. We have the fallow period, and that's 8 years and 9 months. And what's so interesting is if you think back, and I didn't include it here, but you have the 87 crash, and then you have this 12 and a half year run, 620%. You have the dot-com wipeout for basically a decade, effectively, and then you have this 12 and a half year run. There was one that preceded it, also 12 and a half years. So think about this. We know there was a 73, 74 bear market. Yes, it was 2 years. It started literally in January 73. We went down 50%. If you were so genius or brilliant to have bought on the low after the 73, 74 bear market, that's Jan 1, 1975. Count forward 12 and a half years. 1975 to 1987 is 12 years. January to October is 12 years and 10 months. 12 years and 10 months, and we get after the 73, 74 bear market, 12, that's the third time. 12 and a half years, 12 and a half years, 12 and a half years. We're clearly going into a fallow period. It doesn't matter how low it goes. I think it can go lower, but it's not a period to be overweight equities. This is a very clear sequencing to my eye. So we know we've had a bull phase, a bear phase, a bull phase. We know this is, and if anyone's interested in this deck, of course, you can have it. Magnitude, duration, annual returns, and then real returns. Anyway, that's my sort of view on things. If it's helpful, we could talk about gold, or I can stop.
Well, before we go on to gold, because I've had the good fortune to be at one of your nights where you have institutional clients out, and one of the things that really struck me when you went through it was your adherence on kind of a non-traditional moving averages. And specifically, I'd love if you could talk about the fact that you don't believe in the 200-day moving average. You have your own, and just how you came about this and why you think this works. I'd love to kind of understand that a little better.
Sure. So it's interesting. I use the 150-day moving average. I have no pride of authorship, and I inherited that from my teacher and mentor, again, Vince Boning, the German from the Fidelity chart room. But what's so curious is that the 200-day moving average seems to be the one that is the popular. Now, in all my life, in 30 years, I've asked people, why do you use the 200-day moving average? Because I get the question all the time. You've just asked it. Why do you use the 150? And I've gotten 3 answers in 30 years. well, that's the number of calendar days in the something mishmash. And I go, no, that's not right. Okay. The second one has been, well, that was the default. What? Well, you just sat down and started driving the car because that's what Bloomberg defaulted to, or Investors Business Daily. Okay, and the third was, Card, I just don't know. Okay, there has to be some reason, right? And so the work that was done by Vince Bonin was that there is a quarterly phenomenon in markets, and it's associated with earnings and stocks drop and gap on earnings and drop and gap again. And the idea was 13 times 4 is 52. And he was trying to smooth out that quarterly phenomenon. So if you took 2 quarters was the premise, you'd have a 13th or a 26-week moving average. Now, if 150 days, 30 weeks. And through trial and error, by sort of stretching the tails a little bit, it came out as a higher hit rate. And I might be able to put a Bloomberg on here. Let's just do this. So if we were to do QQQ, for instance, ready? G17, let's do this. And let's do a 2-year chart. What a moving average is supposed to do is measure trend. We can either draw a trend line. Watch, I'll draw a trend line, and we'd all agree that's sort of the trend, plus or minus. But I used to do that with pencil and paper all night, stock after stock. There were no computers per se in the late 80s software programs weren't good. But we'd be up all night. So we want all that a moving average is an automated trend line. We would all agree that that's essentially the trend, however one wants to draw it. But I would say that's effectively the trend that the Qs are in. And so a moving average should approximate that. Well, watch. If I put in the 100 moving average and now take away the trend line, the Qs touch it. Watch when I put in the 200. And then when you rally back, look where it hits its head, to the penny. Does that happen with a 200-day? Watch. I'll change this to 200. And it didn't touch the 200-day moving up once on the way up. So let's add them both. I'll add SMA. Here we go. And I think this will be worthwhile. And we're here. Okay. So we would agree that the 100 moving average serves as the trend line, which I was saying is just an automated trend line. It's trying to, that's the actual trend line. Which one did the job? The 150-day, not the 200. Let's try a stock like Dell, for instance, to make a point. So here's Dell. Where does it check back to? And then where does it throw back to? That's not, the 200 is too slow. It not only didn't bounce. So again, just to be clear, if I put in just the one, get rid of the 200, well, it's not letting me get rid of it, but you can see this here. Yes, what we found over time is that the moving average that has the highest hit rate in terms of figuring out trend and where you are in relation to trend is the 100 moving average. And that's inherited, and I've never looked back.
So now, can I, sorry to interrupt there, Kartik, but just a quick question. Have you gone and actually studied that? Like you say that you've looked over time. Have you done it quantitatively, or is it just?
Yes, I've had analysts, quants work with me over the years, and they keep coming back with the same thing. He said it's a higher hit rate. I mean, one could say, okay, what's the difference? It's close, but it has a higher hit rate than the 200 in terms of where you are in relation to where you've been, and I keep getting that back as a finding.
You converted me. I've watched. I've looked at both, and I've adopted your 150. The other thing that I love about your analysis is you have a kind of a cheat sheet, I would say, of different patterns, and you often will pull that up. I was wondering if I could put you on the spot and get you to pull up that one.
Drawings. I call them, right, identifiable bijunctures, and I call them the cave drawings because they're from those who went before us, just as we found them in a cave. My teacher and mentor, who in turn, again, Edwards and McGee, he knew them personally, who in turn from Springfield, Mass., basically, I would say linked back to Charles Dow. 4 identifiable bijunctures, 4 identifiable cell junctures. And so bearish to bullish reversals are very important, and bullish to bearish reversals are very important. And so we're looking for sequencing when something turns from bull to bear, or the reciprocal turns from bear to bull. So this is a bearish to bullish reversal. And what happens is, do you notice this? If you overshoot your 100-moving average, the entry point is on that check back. Notice where it checked back to? To the penny. What's the reciprocal of that? That's the Qs. Once it breaks trend, the shorts it when it throws back. That throwback to a line that's then flattening is the reciprocal of a check back to a line that's then rising, necessarily. And so I'm looking for key inflection points based on the cave drawings. Bearish to bullish reversals are very important, and bullish to bearish reversals are very important. And so just as Dell, when it hits its head, one of the great shorts that you wait for a stock to break, and then notice when you get that throwback, it hits the thing to the penny. You go after it. That throwback, that moment there, is identical to the throwback in Qs, which is the reciprocal of the check back in something like Halo. So these are they, and everything I do is based on the cave drawings.
I love that expression, the cave drawings. Okay, so let's talk about using those cave drawings for analyzing gold.
Sure. So let's look at gold. Just maybe I would just to talk about gold. There are only three types of people. To be fair, it covers the whole world when it relates to gold. There are people that never own gold, will never own gold. Hard stop. And then there are the opposite, people who always own gold. Some people make fun of them as gold bugs or whatever, but they always have it. And then there's the middle crowd who want to own gold, try to, successfully or not, as a hedge during times of volatility, insurance. So let's talk about the middle crowd first. This is a very clear table. Columns are clean, rows are clean, colors are clean. And what it is simply every 20% plus sell-off in the history of the S&P from an all-time high, start date, end date, and the return of the S&P. And then simply what gold did in the exact same time frame. And the right column tells the tale. For those who seek to, successfully or not, be in gold as a hedge, it is incontestable. And here we have just now, Jan 4 peak, June 16 low. The S&P is 24.5 and gold's up 2 for a spread of 27%. So addressing the middle crowd, I think it's a good endeavor. I myself engage in this kind of thing. And embracing gold as something that's practical, as a hedge, it's time tested. So then let's talk about the other two, people who never own gold or people who always own gold. There are people who never own gold, the horrible, they say barbarous relic. They say you spend all this time and money digging out of the ground only to go bury it back in the ground in a vault. It's all stupid. It has no carry. It costs a carry and has no yield. But the truth is gold is a long-term investment. So let's prove that. This is a 3-year comparative chart of gold in something of a gold color, that orange, and the S&P. They're even money. This is a 5-year chart. They're even money. This is a 15-year chart from the market peak in 2007 to present. They're even money. So we're starting to see that gold is now. Here's the S&P from the dot-com peak. Here's the S&P with dividends reinvested. Take it away, put it back. Take it away, put it back. Obviously, dividends are important. This is the index itself, and this is the index with dividends. How's gold done? Forget about the S&P. How's gold done with dividends reinvested? Meaning, it's blown it away. How far do you have to go back to actually have gold and the S&P total return even money? 24 years. So if you come out of college at 22, add 24, anyone who's essentially younger than 55, it has been right to have gold their entire investment career because it is kept up with the S&P with dividends reinvested, which most people don't do. Most people take their dividends out. Gold is an investment, hard stop. And I think gold is on trend, and it bounced to the penny, to the penny, to the penny, and it's down to trend again. And I think one's right to have some, either as a hedge or as a longer-term part of a portfolio.
So is that almost the reciprocal of your cycles call, the fact that we're about to go into 8 years or whatever it was, the fallow period?
I don't know how many years, but a fallow period, right? Or a crash or something that, and I think gold is on the opposite side of that. You know what's interesting, and you'll remember this. When I was a kid, you would go into a Muriel Siebert or Quicken Riley or a Merrill Lynch office, and they always had, as many businesses do, they have these little pamphlets, right? Color pamphlet, and it would be opened up into three. And they always had a pie chart. It was asset allocation. And they always, all my life in the 70s, they always had this much for stocks, the house view, this much for bonds, this much for cash, and this much for gold. It was always a part of the pie. And in 1999, all of them closed the gold wedge. They removed it. Gold was a joke, and you wanted to be in technology and .com and growth. So something that had been in the pamphlets for decades, if not longer, was taken out. Classic, right? Timing error. Said they made fun of gold. And guess what it was? The absolute peak in the market, March 2000, and the absolute low in gold.
All right. That's a fascinating story. I think you and I are roughly the same age. I don't remember the gold pamphlets, but you're probably
not
correct.
A pamphlet, no, the asset allocation.
Yeah, the asset allocation, but those being in the pamphlets, I guess I didn't even notice. Maybe you know what it is. We're Canadian. We probably leave the gold in because we're all
leave the gold smart. Well, they do call Brown's Folly, right? Chancellor of the Exchequer. Basically, Britain sold a great deal of its gold at the low, saying this.
Well, and I think, listen, the Bank of Canada did this. We weren't that far off. We also downticked it as well. So you're absolutely right that the Brown's Folly was a classic time that was very lucrative for those that were buying gold at that point when nobody wanted it. Carter, I know your time's valuable, so we'll finish up here with our 5 questions that we always ask all of our guests. And let's start with your favorite investment book.
Well, I've only read one. It's been referred to here. It's known as Edwards and McGee. I guess the title is technical announcement, but you just look it up. First edition, 1948. I have one of those signed by my teacher mentor. That's the only. I have read the Market Wizards interviews, which are fascinating. I would certainly recommend those.
That's hilarious. Okay, so next question is: do you think the great traders or investors are born or made?
Let's see. It's not or. It's both. There are people who are just inherently great, and there are a lot of people who, through a lot of hard work and trial and error and studying their trades and learning and being coached and working under great mentors, have become great traders who are not. It's both. There are people who are just born gifted and just have a nose for ferreting out opportunities and taking $1 and turning it into 3. And then there are people who have, through hard work and a lot of training and a lot of, stick grit, have become great.
I think that's my best answer I've ever heard. Honestly, I think you summed it up perfectly. Okay, the next one is let's move on to our 2 kind of strategy / market questions. We'll start with the Byron Wien surprise. Byron Wien loved to publish his yearly annual surprises, and what he defined a surprise as is something that the market would assign a less than 1/3 chance of occurring over the next year, but he believes has a greater than 50-50 chance of happening. What would be your Byron Wien surprise for the next year?
Just one thing on first. I understand why he did it. Barton Biggs and Byron Wien were the strategists at Morgan Stanley. They were, a duo of sorts. I guess Barton Biggs was the sort of the big man, but Byron Wien worked in the team and so forth. It's a marketing thing. We did something called random gleanings at DLJ. Because who can assign odds? Odds are a very mathematical thing, right? So it's just to catch people's attention. I'm not poo-pooing or making fun of it, just to know what it is, right? Look, we're talking about it many years later. It's people love to read that the Warren Buffett's newsletter, right? It's one of those things that took on a life of its own, and it's a kitchen sink kind of thing. If you put anything in it that's crazy, that's the point, and anything could happen, right? And odds are only determined by big computers or people who do actuarial things, and so there are no odds. It's just he himself signing an odds when he's not an odds maker. But all of that notwithstanding, I would say the odds of something being lower is that somehow we get out of this and are making big new highs. I would say that's a very low odds thing.
But do you think there's a chance of? Do you think that the market? Do you think the market is overestimating the chance of that occurring, or underestimating the chance of that occurring? Sorry.
I would just say that the chance of that occurring is almost zero. If I could make odds, and I can't make odds either, right? So I would say that would have to be if you were writing a Byron Wien type list, that would be something that would be on there. Big new highs because I don't think anyone who's trying to make odds is expecting that.
All right, now the final strategist question is a fellow Canadian by the name of Don Cox, and Don Cox used to talk about investing on what's on page 16 on its way to page 1, meaning that you don't buy what's on the front cover today, you buy what's going to be on the front cover tomorrow. Do you have a Don Cox type investment that you would say we should be looking at?
That's hard. I think I would just say that you can spend a lot of time building a portfolio, and is it really worth it to say, well, we could have overweight in Walmart and underweight in Target, or have them both and have a little higher exposure to consumer discretion versus staples, and then Coke and Procter, but no, Clorox. That, God, you're never going to get anywhere, right? It's just your benchmark. You have to have something that's truly, obviously risky, but also where you could have a page 16 turn into page 1. And it, by definition, has to be something that's a disruptor, something that's a game changer that could and hopefully become something. And so I would say, as a theme, as an aggregate, as an area, it would have to be biotech, right? So beaten up, just down, some of them trading below cash, but in aggregate, the XBI is an ETF that having a high exposure to a broad basket of biotechnology stocks, because I like healthcare in general as a sector, both for its offensive and defensive characteristics. That biotech is the kind of thing that can go from page 16 to page 1, where DuPont or Ford Motor, that just can never happen.
So that's a great answer. I was wondering, is there any signs, like when you read the tea leaves of your charts, that we're seeing relative strength? Or are there any signs that's
indeed? That's an important point, that we got right down to the COVID low and we're holding. So how you behave at a critical juncture is critical. So to be right at those lows and exhibiting impressive relative. So since mid-May, biotech's up 10, 12%. The S&P is down 3 or 4. I think it is finding its footing, and that it's asymmetrical. If one's wrong and gets involved, it probably doesn't hurt you much. It kind of muddles. But if we're right, you get an outsized return.
Okay. And that's a great answer. I think Don Cox would be really proud of that one. Final question. If you were to give advice to a young person that's starting in our industry, what advice would you give?
Oh, I would have this one. This is as straightforward as it could be. All my life, I've met young people, and they're in their investment banking job, or they're as an analyst job, or they're a trader, but they're not actually involved. And you say, what do you mean they're not involved? The first thing and only thing is you have to have money on the table. And so I've done this, interview people, I said, hi, nice to meet you. And then, can you show me your trade slips? And they're like, what? Yeah, I mean, you have an Ameritrade account, don't you? Or you have an E-Trade, or you have a Schwab, I go, no, I don't. Zero interest in that. Meaning, that's how you learn. And so there's a great expression. The market is the only place where first you get the exam, then you get the lesson.
That's a great line.
People study, and now I'm ready. No, it's the opposite. You talk about it academically. We've all done options, right? You try this out, and you literally get your head handed to you, and you're like, that's how that works. It's the only place where first you get the exam, then you get the lesson. If someone's not having an active interest in the market with their own money, they, I think, are doomed. And so the answer to that question is trade, get yourself involved, and you will learn things only from that.
That's awesome. Okay, Carter, why don't you tell people a little bit more about your firm, how, if anyone's interested in getting your research and how it all works, give us the whole spiel.
Sure. So, just going back to that starting story. So I've been on the sell side, which is 30 years. And so Worth Charting was started, the firm I was working at was sold out to another firm. And essentially, I was just facing two things. It was we'd been in COVID, and I was traveling, 3 out of 4 days a week, right? No one travels over. And so every week, you'd always be, and I was facing the travel schedule starting. It was going to be the Austin, Dallas, Houston, San Antonio trip. And the next week, it was the Chicago, Milwaukee, Detroit trip. And then also the new deal was a lot of stock. I don't want to get restricted stock. And so I said, I'm going to start Worth Charting. And so I am one of hundreds of thousands of chartists. And the truth is, and this is candid, I don't know anything you don't know. I've just spent a lifetime studying and learning, getting exams, and getting my head handed to me. And so what worth charting is, and I think in this sense it's unique, there are a lot of great chartists, and many of them I know, and they work for big sell-side firms, but their research is not really available to the individual, maybe indirectly through a broker. But we have institutional clients talking to the biggest pension plans, mutual funds, hedge funds in the world every day. So not only are we an institutional chart company, technical analysis product, we also have that same output available for individuals, which typically is not the case. And so Worth Charting is an online subscription service where the content that I disseminate, the team disseminates for the biggest institutional clients in the world is available. It's a slightly different with to individuals. And so in that sense, there are a lot of great institutional technicians, and there are a lot of people who have online services. But I don't think there's anyone that has been sort of II ranked for 15 years, top 1, 2, or 3, institutional level quality, if you will, who's also making their product available to individuals.
All right, that's great. And so if they want to find out more about that product, where do they go?
You just go right on the internet, and it's worthcharting.com.
And Carter, I love your expression, and it reminds me of the one that I've actually adopted for myself. As I say at the macro tours, all I do is bring 25 years of mistakes to the party, and it's very similar. And I love the humility that you approach the markets, because if you don't, you're going to get your head handed to you. And listen, I've listened to your technical analysis, and for those who listen to the show for a long time, know that I'm not a big technical analysis fan, because I find a lot of them assign too much certainty to things, and that it's a little too much voodoo. But I always find myself gravitated always to your analysis, and I feel like, oh geez, he just finds a way to make it simple, yet something that everyone's overlooked, and it just ends up more than often than not, when your trades, you put them up, they work. So I highly suggest everyone go have a look at Worth Charting. It's a great service, and I just want to thank you again for your time to sharing it with us today.
I'm humbled. What a pleasure. Thank you for having me.
Thanks, Carter. All right, folks, it's that time of month again. It's the time when Harris Kupperman, a.k.a. Kuppy, joins us. Harris, thanks for coming on.
Hey, thanks for having me on. It's been a while.
It has been a while since I've chatted with you, and I do have some stuff I want to talk to you about with uranium and energy. But before we start with those, let's dig into the home builders.
That's a crowd favorite.
Yeah, it really is, isn't it? The hatred out there for our poor little home builder stocks is unbelievable. And actually, to be fair to you're not really home builders as much as you are like what would you call it? Home improvements? Why don't you walk us through your thesis?
Well, I think you call it the supply chain for home builders. Home building is a really terrible business. You lock up a bunch of land, you prep the land, you build a house, you have to deliver the house. You're at the whole time fighting, your margins and cost pressures, and hoping you can get the jobs done on time. And it's just a terrible place. You don't want your capital tied up. Meanwhile, these building trades, these supply chain companies are phenomenal businesses. They just turn over their working capital over and over again and have a decent margin doing it, and the returns on capital are just obscene. And so I'm along some of these other companies that are supplying building products to the home builders.
Yeah, it's almost like the picks and shovel arguments. Like you don't get rich buying the gold companies. You get rich selling to the people that are trying to prosper for gold. Okay, so what's happened though? We've seen I guess Powell's killed the recovery, and they've shot these stocks.
Yeah, pretty much. I mean, everyone has PTSD from 2008, and look, mortgage rates are 5. I mean, at almost any moment in time, except for the last decade, that was considered really good. And so people have this PTSD that you can have a housing crash. And the honest truth is, you're not having a housing crash. You have some issues with affordability. But I like to joke that, this time last year, there were 10 people that showed up for each home for sale, and now there's like 6.
Right.
They just can't build this stuff fast enough. And I think that's really the trend here.
It's a real disconnect between what you're seeing on Main Street versus Wall Street.
That's usually how it is.
All right. What names do you mind sharing some of the names that you like?
Well, yeah, sure. I mean, I'm in Builders First Source. Absolutely love that company. I think it's well managed. All the money goes into buybacks. It's got an obscene return on capital. It's something of a consolidator in the industry. And as they continue to consolidate, their margins are going to expand. I think their margins will structurally expand by, let's call it 50 bips a year as they consolidate the industry. And it's going to end up being just an amazingly lucrative, high ROIC business.
So why do you give people the symbol for that one?
BLDR.
Okay, BLDR. Okay, that's one of them. What else? What other names do you have that you like?
I like Louisiana Pacific. Ticker's LPX. They're in the OSB industry. There's basically 5 players left. It's really consolidated quite a lot. And when you have 5 players left, you end up with rational pricing, hopefully. And the demand for OSB just tracks homes and construction. And I think the demand will stay very elevated. And they're shifting increasingly to this siding product they have. And you look at the average home in America, it's over 40 years old, and you have to replace the siding. And so the business is pivoting to something that's a much higher return on capital business, less cyclical business, less tied to the price of lumber like OSB is. And they keep taking market share in the business. And if you just look at their siding business, it's worth way more than the market cap is. And you're going to get a dominant number 2 OSB producer in the United States for free. I mean, actually negative, which is too cheap in my book. And so we own a pile of that too. And of course, I own my Joe.
That's right, the Joe. You can never forget the Joe. One of the things that I might argue is that people will say, "Oh, but there's a recession coming," which we could debate whether there actually is one. But I would almost say that these stocks are already priced for recession.
Oh, yeah. I mean, if you assume we go back to, say, 2018, 2019 sort of returns in terms of units built for, say, builder, and you assume margins compress back to where they were in 2018, 19, I mean, I think you're buying builder at like 6 times earnings. And 2018, 19, it was like a 40% return on capital business, and still growing organically. Like, this is a dominant business. Meanwhile, they've executed a number of mergers that have synergies, and the overall margins should increase just by taking out duplicative cost structures and whatnot. So, no, I think this is a very, very high quality business that should be valued like a high quality business, probably 15, 20 times wherever you think earnings will be at the mid-cycle.
You know what I think is ironic? Sorry to interrupt there, Kuppy, but what I think is ironic is that in the 2005-6 run-up, many of these Wall Street models didn't even have the ability to put in negative price home appreciation on a nationwide level because they had never seen it. And so we've gone from believing that houses never go down on a nationwide basis to believing that every single decline looks like 2007-8.
Right. And I just don't think that's accurate. If you look historically, before 2007-8, you'd have regions that had a bad run at it. And I think you're going to see that again this cycle. You have this massive population move from cities to suburbs, and then in particular from the shitty states to Florida. And, I think there'll be no one left in New York in 5 years at the rate we're going. And so, even the builders are starting to talk about this. They're like, "Oh, the Northeast sucks for us. California sucks." But they call it West Coast. But everyone knows what they're saying. And and then Florida is just in fuego, and Texas, and Tennessee, and Georgia. You're having a giant population move, and it's really supporting these regions.
And then on a macro level, there's also the whole thing about the millennials. Everyone thinks that boomers are so important, and they don't look at the boomers are important to most financial markets because in terms of assets, they own all the most assets. But when you look at the actual size of the different cohorts, there's nobody bigger than the millennials, and they've been sitting in their parents' basement for the past, 10, 20 years, or 10 years at least, just shell-shocked from the 2008 crash, not willing to buy a home. And to me, it looks like they're going out and starting to make families, and they're going to do what every other generation does.
Yeah, I think the millennials kind of just pushed everything off like 10 years on family formation. Just millennials are kind of lazy, I guess.
You said it, not me.
I think I'm a borderline millennial.
I know you're an elder millennial. Or I think you're an exennial, they call them, something about Star Wars, and no, honestly, there is something in between, or an elder millennial. And I just like to remind people that everyone thinks the millennials are a certain way, but if you think back to the hippies of the 1960s eventually turned into the yuppies, and everyone forgets that. So I don't think the millennials are. Yes, there are elements that are different, but in terms of they are going to do what all humans do, and they're going to go make houses, make family formation. And yes, maybe they'll have less, maybe they won't do it as much, and maybe they'll have less kids. But to think that they're not going to do it at all is just naive. So I agree with you. I think there's a big, huge like pig in the python kind of lump coming through that we're going to have to digest, and I just see the demand continuing, and I'm just shocked that everyone else is so bearish and just thinks that.
If you think that we do more than 1 million units of single family a year, which is kind of where I think we are, just because we get back to trend line, you almost ignore the 5 million that we need of catch up, plus the 1 million or 2 you need for migration. And it also ignores the fact that a bunch of homes are suddenly doing Airbnb and kind of out of the supply for rental stock. But if you just assume we go back to trend lines, so that kind of gives you that buffer from those other 2 points, and you're at 1 million, 1.2 million homes a year. I mean, I think Builders First sourced a couple $100 stock in 3 years, and I think Louisiana Pacific also is, and I've gone on the record and said I think Joe's a couple $100 stock also, and so I just think these are really interesting opportunities, and everyone has this PTSD because the 10-year went over 3. It kind of kissed over 3 for a few weeks. And if you look at what's happening macro, the euro dollar, the 23s versus 22s kind of inverted, and kind of is telling JPOW it's time to pivot. You look at commodities. I mean, zinc, lead, nickel. Copper's the big one. They've all rolled over. Shipping rates from Asia have rolled over. All this happened in the last 3 months. I mean, everything's rolling over. I don't think we're getting a recession. I think we're just going back to trend line as people figure out all the bottlenecks and stuff.
It's almost been in the last 3 weeks that it really has pivoted. I think we hit peak hawkishness, at least in terms of relative to expectations.
I hope so.
Yeah,
I'm really wrong. But I think you're in a world where JPOW has some breathing space now to say we're doing 75 in July, and then let's take a wait and see how it all pans out. And I think when he says we're taking a wait and see, I think the market goes absolutely insane. I can't believe the amount of bearishness that exists in this market. All sentiment readers readings are at extremes. You have cash on the sidelines at extreme. I talked to my friends. They didn't want to talk about stocks anymore. I mean, I have some friends that run hedge funds. I don't think they've logged into their account in a month. They just don't even want to think about it. That's usually, I mean, we're so preconditioned to have like a March 2020 V bottom, and it just roars. And people forget that in bear markets, bottoms, trading bottoms get formed by just dejection and hatred and annoyance. And you don't have this, cataclysmic crash with the VIX at, 80. It just kind of like stops going down one day. And then it starts going up and everyone has to chase it.
I completely agree. And the other thing is that we all think that stocks either go down 30% in a year or up 40% a year. And they forget that a lot of times what a year looks like is down 20 or down 18, back up 3, down 10 to finish up 8. And that's much more than people think. And the opportunities actually are within the market more so than just owning the market. And
right.
I think there's huge opportunities if you can pick the right sectors.
Right. And I was going to just add that when you own a Ponzi scheme, if it goes down, the cost of capital goes up. And so it's reflexive to the way down because it still needs to raise capital. When you own a company that's very profitable with massive cash flow and they have a buyback in place, when the stock price goes down, it's just more accretive for them to continue running their business and buying in the shares. And it's reflexive on the way back up, when the turn does come. And I mostly own companies with aggressive buybacks and lots of cash flow that trade at like 2 and 3 times next year's cash flow. It's kind of crazy how cheap a lot of these things are.
That's a great point. Now, okay, let's get on to the next subject, which is we're going to talk energy. And let's start with uranium. And I want to talk about uranium, and I purposely have not asked you when we've been talking off air about how the enrichment works and the whole process so that we could do it, here so that everyone else learns at the exact same time. I am a little bit of a noob when it comes to understanding the dynamics of it. And a lot of times you start telling me, oh, no, it's the enrichment or it's this, this, and this. And specifically when we had this situation where Biden announced that they were going to increase the amount of uranium they bought, it had to do with the type and what that meant. And I just want to go through this and explain to me like I'm 10 years old learning about uranium for the first time, this whole idea of different types and how the enrichment works.
Okay, we're going to go through this. I'm no expert myself, so I'm sure someone in the crowd will laugh at me and point out my flaws. But you basically take U3O8 out of the ground and you send it to a conversion facility and you turn it into hexafluoride. And then from there, you enrich it. And once it's enriched, it can then be loaded into rods, fuel rods or assemblies of some type. And there's multiple different types of nuclear power plants. And they all need different grades and different sort of assemblies. But you basically have that three-step process. You go U3O8 to conversion to enrichment to a fuel assembly.
Okay.
And there's some bottlenecks along the way there that are suddenly important because we've tried to take Russia out of our uranium industry, which is something we probably should have done like 20 years ago.
Right.
And, so there's a bottleneck in conversion right now. There's a big bottleneck in conversion. There's just not enough capacity if you don't use Russia. And then we have a bottleneck in enrichment. And the enrichment's the one I find interesting because what's happened for the last decade or so is that they've been doing something called underfeeding. Okay. And so think of this like if you have orange juice and you have a big juice press, you use that juice press and you take every drop of orange out of the orange juice because you just press it at such huge weights, and you can get 99% of the juice out of an orange.
Okay.
So that's underfeeding. Now let's go to overfeeding. Overfeeding is if I try to juice it myself with one of those juice machines and I twist it a bit, maybe I get 60% of the juice out, but I'm kind of lazy and I just don't go at it because it's a big bucket of oranges and it's just easier to twist each one to 60. Okay. So that's overfeeding. And the net result is when you underfeed, they were getting about 20 million pounds of extra uranium out of the enrichment process because they were extracting all the uranium through the centrifuge. Okay. When there's a lack of centrifuge capacity because it's all stuck in Russia, that 20 million pounds goes away because you're not going to take all the uranium out of the feed.
And is that because we don't have the ability to do that, or it takes longer time? Why are we forced to overfeed?
So we don't have the capacity of centrifuges for the enrichment process. So what we're doing is we're purposely saying we have a shortage of capacity. We're only going to get 60% out, like the orange juice example. And don't hold that number on uranium, but we're only going to get some of it out because we don't have enough capacity to process all of it. And so we're just going to run it through really fast. And so the net result is that you go from 20 million pounds of underfeeding, which was added to the supply, and suddenly you're overfeeding. And there's really no limit to how much overfeeding you could do. But, that 20 goes away, but also, more goes away. It could be another 10 or 20 or 30. It just depends on how bad the bottleneck is. But you could go from a situation where you have, say, 150 million of total supply, of which 20 is the underfeeding. And suddenly you go to 130 of supply, maybe you go to 120 or 110 of supply. And as you can imagine, the demand side at 185 is pretty static because you never turn off a nuclear power plant. And all this does is make the deficit far more extreme. And eventually, you need more supply to make up for the deficit, but you need a higher price to, incentivize that supply to come back online. And so, it's a very long-winded way of saying that a bull thesis I've had for 9 months just got a whole lot more bullish.
Okay, so I just want to understand this. It almost sounds reflexive to me in that, is it a function of it takes longer to do the underfeeding, or is it a function that we don't have the capacity to underfeed?
We don't have the capacity because there's just not enough enrichment capacity in the West. So
I see. So once you took Russia out of it, we now need to, enrich a certain amount. But to get to that, we have to overfeed, which is kind of seems counterintuitive to me. But anyways, overfeed to get it done more quickly. So we, in essence, say we're not going to be as efficient because we need to get it because we're kind of behind.
But think of it this way. Let's say we have two juice presses and we're getting 99% of the juice out, and one of the juice presses breaks. That's being, Russia offline. and the factory says, "Hey, Kuppy, why don't you go there and with your bare hands try to get some of the juice out because we have an order to fill." And suddenly, in a box of 1,000 oranges, half of them are still getting 99%, and half of them are getting 60%.
Okay. And now, okay, and that's with the enrichment taken out. So how do you think this plays out? Because now all of a sudden we see Biden waking up to the idea that this is actually a strategic energy, and they are trying to deal with it. Why don't you talk to us about that policy change and how you think that plays out in the coming quarters, years, and what that means for the uranium market?
Well, I mean, I think everyone's kind of realized that America needs uranium in order to run the nuclear power plants we have, which are a pretty big component of our total electricity here. And so Biden kind of panicked, well, baby panic. He's buying 1 million pounds of U3O8 for a stockpile, which isn't much of a stockpile, really, when you think about 185 million pounds a year globally. But I think it's a start of a bigger stockpile that they intend to build. And so it's just like having another Sprott Physical Uranium Trust munching away on physical supply. I assume once this 1 million pound tender is done, they'll do another one. And so it's just another mouth to feed from a limited uranium stockpile, global inventory. And one day they'll finally get that last pound out of the warehouse, and the price will go up. And so I've stayed long and been adding on this pullback. It's kind of funny, actually, because everyone's fixated on the Sprott Physical Uranium Trust, and it's trading at a discount to NAV right now. And it hasn't really been buying that many pounds, and everyone's fixating on it. And they're kind of ignoring that that's just one piece of a much bigger ecosystem of uranium. And I think in the end, we had a lot of wise guy hedge funds that bought into this thing. They thought it was going to squeeze like GameStop, and they forgot that it took a year before GameStop really got going. And I think it's a similar situation. People kind of got bored of it. They started selling. It went to a discount to NAV. It brought more selling. Guys were down on the quarter. Guys got redemptions. Guys wanted to go chase some other shiny thing. And you just had a lot of selling, and it's trading at discounts to NAV, which usually is an opportunity, I think. Yeah. And I think people need to step back and look at the bigger picture. I think the first time I came on your show and talked about uranium, it was at 31, and that was 9 months ago, and here we are at 51, and so that's 2/3 appreciation in 9 months. And I wish all my trades worked that way.
So now, do you still like the SPUT as your number one play? You think stay away from the miners?
Oh, definitely stay away from the miners. No, I own Spud. I own some of the UK version, Yellow Cake. I own some Kazatomprom, which has done poorly for me. But no, I think Spud's the way to play this. It's just a low risk way to get exposure to a trend. I hate the miners always in every industry, and every time I buy the miners, I regret it. And every time that I buy the physical, I prefer it because I have pretty good foresight on what the physical will do. It's just supply and demand, and that's kind of easy to predict. It's really a question with all these commodities. If it's in a deficit, the price will go up. It's just a question of when. And when it comes to investing, a lot of the best investments are the ones where the market wants certainty on when, and they want it in the next 3 months because everyone's trying to hit their quarterly number. And if you're willing to be a little patient, you usually get paid. Right. And so I like these sort of trades, and I got a whole lot of spot.
Okay, speaking of commodities that might squeeze in the future, let's talk about oil. Obviously, it got rinsed with the correction of the last, I guess that was when I was on vacation. I missed it. Big down move. Do you think that we've cleaned out the excess speculators and that energy is ready to march back, continue its march higher?
Yeah, I really do think so. I think when the commitment of traders comes out in a few hours, I think you're going to see a pretty sizable build in shorts. Look at. I like looking at divergences in relative strength in markets, especially on a big sell-off, because it's kind of telling you who's the strong guy. Because in a sell-off, they sell everything, and oftentimes guys sell the winners to fund the losers, or they get redeemed or liquidated. They sell everything, and look at what copper, zinc, lead, all these industrial commodities that are really tied to GDP. Just look what they've done in the last 2 months. And then look at oil. Yeah, it's pulled back a little from the highs, but it really hasn't pulled back. It's just making this big, tight pennant. We're drawing down a few million barrels a day every day, and that includes the SPR. And China's reopening. And we were drawing down when China was shut, and India is accelerating. I think it's going to be very tight this fall, and I think it's going to explode. I remain of the view that oil is going to surprise people in a stunning way. It's going to go to a couple hundred, and it's going to be the next Lehman moment. The thing about the Lehman moment in 2008 was that no one knew where they stood. You looked at your books and you go, is my counterparty going to pay me? Is cash going to settle? What's happening? Who's next? What's happening? And I think, and because no one knew what would happen, it was terrifying. And with oil, if it starts, marching $5 a day, it's equally terrifying because at 500 oil, Walmart's going to do like a negative 30 comp. And, no, but seriously, the price of oil mostly, impacts middle class guys, the sort of guys going to Walmart that really don't have much disposable income. And when the Walmarts of the world start having huge negative comps, think what everything else does. I keep saying that oil is going to kill every QSIP, and I really do believe that. And it's kind of one of those. It's back to like the uranium thing. It seems almost preordained. It's just a question of when. And a lot of things in investing are actually pretty obvious. It's just a question of when. And getting the timing off by a few months can be very expensive. And so I don't usually focus on the timing. I put these trades on and I just let them ride. And it just seems like if you have a couple million barrel deficit every day and you keep drawing down global inventories, eventually something's gonna break. And I think what'll break is the price to the upside. And I think there's a lot of structured finance around oil to the upside. And I think it becomes very, very reflexive, not just a gamma squeeze, but you have hedge books that blow up and you have all this sort of stuff that at a higher oil price, suddenly people get margin calls. And it just leads to a higher oil price.
Well, one thing I'll just interject there is everyone's talking about this. Oh, 112, it's so high. It's so high. Like it was 140. When was that? 08?
Yeah, 140.08.
And then when you discount that to today's dollars using CPI, I did the math. It's roughly $200. So it's not like this is that high a price. We're like everyone's freaking out about it, but our economy has been here before. This isn't that unusual. And I think when you discount it into today's dollars, I think that this was from 2010 to 2015, it varied between 100 and 150. So I just don't get what people are freaking out about in terms of the price of oil. Yes, it's hurting. Yes, it's causing people to, spend a little more, but it's not the end of the world like everyone thinks it is. And not only that, let's face it, the U.S. and Canada are actually in great shape when it comes to this. And if the governments get out of the way and lets them, pump a little bit more, it's going to be even better.
Yeah, no, I agree. I think the difference, though, is that the last time oil was at 145, the dollar was 75, not at, 102 today or something. And so it's not so much America that's going to, break. It's going to be the countries that depend on oil, like Japan or Turkey. I mean, these countries are literally just going to be murdered by oil. And so I think that's what's going to happen. And with Powell raising rates and raising the dollar, he's just going to basically, bankrupt the periphery. And the periphery is now Japan and Europe. Japan's literally having an emerging markets crisis, as is Europe, and they refuse to accept that they're having an EM crisis.
That's a good way of putting it. The EM that's moved into the DM. I completely agree. Okay, so from this perspective, is it again the same thing? You just own the futures? Like, are you still in love with the far dated futures? Is there anything else that you position wise to take advantage of this coming squeeze?
Well, I own the futures. I own the futures call options, futures spreads. I've been adding more to my services names just because they've been absolutely murdered. I mean, Valaris is down from 60 to 41 in like a week and a half.
So that's symbol VAL.
Yeah, Weatherford is down from 35 to 20 in like a week and a half. I don't know what's happening, but it almost feels like some guy blew up or got liquidated or something. Because in the end, something like a Valaris, it has a backlog, and the price of oil goes up and down, but the backlog doesn't change. Right. And so, and quite honestly, we're talking right now and. WTI is at 108. I mean, that's a very, very profitable price for offshore drilling. And so I just don't think it's representative of what's happening in the sector. So I've added some there. And then I don't know. I'm kind of a nut, but I do think that this fall, when J-Pow relents on the rate side, oil just goes screaming. Remember, it's outperformed all the other industrial commodities, and so when he, steps off the gas on the hawkishness, I just think it screams out of control. And I have a bunch of these December 200 by 250 by 300 butterflies on, and
Oh,
I know
that's you trading those.
Yeah, I'm the only nut. I mean, I think I have most of the open interest in the 100 calls also, in the 200, no, the 100 calls of 25. I'm proud of myself. I kind of kinked the whole vol surface there because I bought so many of the same. But no, these butters, I mean, look, they're pricing at 20 cents right now. And so if it gets to 210, if oil gets to 210, you get paid, what's that, 50 times your money, which is a damn good return. And, the market's pricing this like this is zero chance. Like I have a better likelihood of getting, hit by an asteroid in my office. And I tend to think it's more like a 50-50 shot. And so, you don't want to go crazy buying premium, but I bought quite a lot of these stupid things. And I'm almost more worried that we blow out the top strike at 300 than I am that it doesn't hit, which, shows you where my bullish level is. I'm kind of, set my bullishness at 11. But, but I own a bunch of these things. I own all sorts of structures everywhere. And I just like the fact that the oil vol, is super low because of the shape of the futures curve. It's very, very backwardated. So even just going out to December, the curve drops down quite a bit. And the net result is that you're buying call options that are, kind of flattish with the front price, but they're being priced very, very cheaply. And especially as you go further out in the curve, implied volatility collapses, it's in the teens, which just seems crazy for a product with a realized volatility between 30 and 60, that you could price out a long dated paper, especially because, when you get past, say, 2024, the futures strip is in the low 70s. And I don't think you could produce oil right now, the marginal barrel, if you want 100 million barrels at 70. It's just that's below the break even. And these guys need to have a cost of capital that they have to think of, and they also have to have a return on their money. I mean, everyone just thinks the world goes back to 2015, where some oil guy goes to Wall Street and says, "Oh, look at my 100 IRRs at 35 oil, give me money." And then, they get to borrow money at like 50 bips wide of where junk trades. That day is over. You can't just go drill unprofitable wells and, fudge the numbers and hope no one figures it out. And so you actually have to fund these things through retained earnings and cash flow. And, the companies that are still left got some discipline. They're not doing that. And so I just don't see anyone producing oil. I just don't see the price of oil dropping outside of like some sort of like fluke flash crashy thing below 70, because it's not profitable to do it there at 70. And so as a result, you can basically buy something below the cost of production at a super low implied vol. And I think, if you wait it out 4 years, you get your money back, or you make a ton of money. And I just love trading all along that curve. I think the curve's all screwed up. And I'd add one more thing. And I'm not usually the sort of guy that buys like USO and BNO, but BNO is Brent. Everyone knows USO is WTI. But there's because of the backwardation, there's a pretty aggressive roll yield, which means that if you go out the curve and buy some of this longer dated paper, it looks like you're 20% out of the money. But if the roll yield on BNO is 3% a month or 4% a month, you go out 6 months and you're basically buying the flat price. And the whole vol curve hasn't priced in this roll yield. I mean, either they're pricing in that the roll yield goes away and the curve goes flat, or they're just morons and they don't understand how a roll yield works in the Black Scholes. And so, I think I'm going to school that market maker.
Well, don't you know, Kuppy, that in 4 years we're all going to be using electric cars, and there'll be no more need for fossil fuels.
I won't be using electric cars in Puerto Rico because the power goes out too much.
Listen, you know what? I'll let you go because it was the middle of the trading day. But why don't you tell people about your product, how it works, what you do, where they can find more about what you're talking about, and all this good stuff.
Hey, great. You can follow me at Adventures in Capitalism. I have a blog there. I write kind of regularly. Whenever I have something to say, I just throw it down on paper. And then I publish an event-driven monitor called KEDM. Go to KEDM.com and take a free trial. We offer a 1 month free trial. But we track over 20 event-driven strategies. I mean, bunch of the names we've talked about, we've mentioned through the monitor. I've actually flagged them through the monitor. I also have been writing a couple pages of macro commentary each week. So if you took a trial a year ago, give us another email address and try it again. But you won't be the first or last that's tried that. But I think we've improved the product quite dramatically. We've hired some more people, and we're looking to hire some more people going forward and just keep making the product better. And we've taken the feedback we've gotten from readers that they want to see more macro, they want to see more actionable stuff, and we have some more improvements on the way. And finally, we've been doing these happy hours on a pretty regular basis. About one Friday a month, where you can call in and ask any expert what's happening, what they think. Last time we had Carson Block on, I thought it was outstanding. We're looking to have our next guest sometime soon. So, you join the full package.
And the other thing you didn't mention was the Discord server, who many people told me that they find it to be one of the best communities out there in terms of when they have something they want to know about, and they just throw it out there, and your group is more than happy to help, and a bunch of knowledgeable people on there.
Yeah, we have a really great Discord group. It's mostly hedge fund guys, and you post whatever you want, and there's always someone who knows the story better and has done the work, and it's just really amazing. It cuts all the bullshit that Twitter has, and these are just guys professionally focused on grabbing alpha.
That Discord server is almost worth it alone there, even without your great commentary. Kuppy, one of the things is, am I not mistaken that you're going to put up prices shortly, and therefore people should rush in before you change?
Yes, we are putting up pricing. We kind of want to keep this as a smaller private group, and we've gotten kind of where we wanted to get, and we put the pricing up a bit. You don't want to have 200. You don't want to have like a couple thousand people in the Discord room, and so we put pricing up. You need to sign up in the near future, and you'll get the discounted price, and we get grandfathered in at the old price. And after that, the price is going up. I mean, it's inflation; it's not transitory.
That's a great way to end it. Thanks again for your time, Kuppy. Have a great month, and we'll see you next month.
Sure, sounds good. Can't wait.
Thanks. Take care. It's time for Talking Charts. What do you have in store for us?
All right. Well, let's start off with what me and Steve Sosnick were talking about as the top three things last week. And we were talking about those 10-year yields, just asking whether 3% was going to be broken. And well, it did. I mean, that was a pretty big breakdown. And what's interesting to me is that that's always what I look for when starting to observe a bottoming formation. First of all, this is a yield, so let me just put up like a 10-year bond. When I look for bottoming formations, is a complete and total reversal of the last sell cycle. And we really have basically the entire June sell-off now almost completely reversed. If we see that it doesn't make lower lows, that compounded by your Lacey Hunt cheap shots, we may actually have a short-term bottom establishing itself on bonds. It's like a combination of sentiment and technicals.
So tell everyone what the Lacey Hunt cheap shot was that I sent.
Well, I mean, you were just talking about how bad bonds have done here over the last 100 years.
Yeah, it was the worst start or the worst performance of the bond market since George Washington or something.
Yeah, it was.
It was a bad go. It was a bad go. That's the understatement of the year. It was a bad go.
It didn't work out for the bond bulls that much.
It didn't work out for the bond bulls, but I'll bet you anything that me throwing that kind of chirp at you is going to mark the bottom, and
the market gods are going to sting you. That's the way it works.
That's the way it works when you chirp.
Yeah. So last week we were also looking at the breakdown in the nat gas markets, and what was interesting was by the way, you got rid of your strip, didn't you? You
yes,
bailed.
I did. Although I did buy it back. Or I haven't actually bought this one back, but I'm buying energy as we speak this week, and at some point I'm pulling the trigger on this whole strip. I love it down here. And I know you're going to tell me it looks like shit, the chart formation.
Well, the chart does look like shit, but the point is that once it all completely retraces all the way to the bottom like an Eiffel Tower formation, then you could literally buy it at the bottom. I mean, the damage is already rearview mirror, right? The thing has almost been halved. off of its high in less than a month. So like there's a point where the damage is rearview mirror. So it did continue to break down. It did actually break some key technical levels. On the short term, the vulnerability is for it to work its way down to like 5 or something. But I just to the point, we're probably much closer to a buyable low. But the thing is to me, it's about the bigger thing of the entire commodity complex outside of the markets in oil. The entire commodity complex has just been getting crushed.
Yeah, it's
right?
finally the flush that we were worried about as the speculators got too long has finally occurred, and it looks like Powell's hawkish rhetoric and actual policy is finally having its effect on the actual commodity prices. The real question, Patrick, is though, is this just a correction in the longer term trend, or was that a top that we won't see for a while?
I would take actually neither of those. Like whether I am just a fool for having thought that massive backwardation in the curve that had the 2022s trading double that of the entire term structure going out a decade. I thought there was going to be a huge flattening of that. But I think that in the bigger context, there is going to be an energy bull market that will continue. But it's just, it was absurd that nat gas was trading up there. And now we're suddenly seeing a much flatter term structure, which is exactly a time to step up for buying a strip the way you're thinking about. Like at some stage, it will make sense. I'm not buying any right now, but it'll be really interesting to see what develops there. Anyway,
that's why you have all the fingers on your hand, and I'm missing a whole bunch.
Well, dude, there's other places I lost fingers. Like maybe I didn't on the nat gas market, but anyway, the other thing we were just asking is whether or not there was going to be whether what we saw was a short-term market bounce or whether or not it's a more meaningful short-term bottom, and so far, I have to say, it feels like a bounce. And we talked about this on Wednesday, but like. This market just has not shown anything bullish. There is not one technical thing you can say bullish about this market. Support lines aren't holding. The previous lows are acting as overhead resistance. Short-term buying immediately met with selling. Almost all of the price action and tape remains negative. Breadth is horrible. One can argue that things are starting to get cheap, but the one characteristic of a bear market is cheap shit just keeps getting cheaper. And just because things are cheap is not enough to already say a bottom is in. I think that this market going into next week is on shaky grounds. Like there's no guarantees, but I wouldn't be betting on the long side of the market here.
You sound like Obi-Wan, something so wise. Cheap shit just keeps getting cheaper. I have to give you a lot of kudos, though, Patrick. You have been bearish and staying with it and not getting shaken off, not getting sucked into the kind of it's cheap, you should buy it. And good for you. Like it's definitely tough to argue. It's tough to argue with the price action.
Yeah, no, but that's the whole point is that at some stage, the real trick, and I mean, think about when both of us made that call on the turn point during the March 2020 low. We both flipped bullish in a pretty reasonable short window of time right along the bottom. And at least we covered all our shorts pretty much right into the downdraft. But the key here is identifying the characteristics that will mark a turn point, right? Like when is it because every bear market ends with a once in a decade buying opportunity, and you can't be so bearish that you don't look for the end game, which is that you have to buy at the end of this. The thing is that right now it feels more like a fifth inning of the bear market than it does the ninth inning of it, and I think you just have to kind of stay on the sideline and let the bear play out a little bit before going in there for those longer term buys.
Sounds good. Okay, what are you watching for next week?
We both are. We're going to watch that jobs number.
Well, yeah. Yeah, no, I actually think the jobs number will be very important. The market has run ahead of the Fed, assuming that we're going to have not just a slowdown. I would argue that increasingly a recession is being priced in. So it'll be interesting to see that if we get the weakening of the jobs number, how the market reacts to it. Will bad news now be good news for the price action?
Yep.
I would argue, I think we are going to be at that stage where if we start to get unemployment ticking up, that the stock market will rally, because I think it'll take the pressure off of Powell to be so hawkish, and I think that was really what was driving.
Well, I mean, there's always going to be that stuff, where you're going to have these little reactions. But I think the real downside risk of the stock market comes from the fact that the knock-on effects of this tightening could break something, and usually people don't see, or we're not even talking about that one thing that ultimately is stressed by the tightening of credit conditions. It'll be really interesting to see whether there is something that will break in the coming summer. Will there be something that simply can't handle these market conditions and it's revealed? And then does the market have a freak out about it? I mean, that's all pure speculation, but I'll be watching eyes wide open to see.
I do think that there's going to be something like that, Patrick, but I don't think it's going to be in the traditional markets like we think. And I'll leave those to decide where they think, where I think that's going to end up being. But I think the banks and there's not as much leverage in the actual traditional finance arena. And you should ask yourself, where is the leverage in the system? No, where is the leverage in the system? Because ultimately, it's leverage that gets you all the time. That is what causes the kind of just sell at any price.
Well,
and
I mean,
ask
the crypto
yourself,
was clearly the first wave.
You said it. You said it, not me.
No, but I mean, I'm only observing in hindsight. Like, I'm not making a forecast forward.
It just like it looks like there was way more leverage in that system than anyone ever. Well, than they assumed there was, and I'm interested to see that if maybe that's where we continue to see pressure and it gets worse from here. And the real question I have that I've yet to figure out, if that does get really bad, Patrick, does it bleed into the traditional markets? Everyone tells me it doesn't. Everyone says, no, it's small. Oh, no, it doesn't matter. It's not going to do it. I'm still, a little part of me is worried that eventually at some point that gets so bad that it actually causes pain in the real markets. Anyways, FOMC.
There's the meeting minutes, but it's not just the FOMC. There's a number of central banks around the world that are chatting and have their meetings. So, like, obviously, we have to keep an eye on all the central banks.
So, just to be clear, 1 second, that's not the FOMC meeting. That's just the minutes of the minutes. Yes.
Yeah, it's the release of the minutes. But the point, though, is that we do have central bank. Like, we have to nonstop watch central banks because they have become the centerpiece. Until something breaks, they are the focal point here. And whether it's whether or not Australia moves on its rates or whichever central banks are also up to bat, it's going to be important to watch. And my eyes are going to be on that. Any thoughts on that?
No, I agree with you that the central banks are increasingly important, and it's almost the opposite because they are the ones putting the brakes on the economy. So we need to get signs that they have decided that we've slowed down enough that the economy is the speed upon which we're going is at a point where they feel like they can pull up on the brakes. So the question is, who's going to do it first? How's it going to work? What's going to be the order? And how do the markets react? It's something you got to watch.
All right. So, number one thing to watch, the Euro USD, which is not the dollar, right? You didn't have a say in this.
By the way, no, I didn't have a say in this, and Patrick has obviously put the dollar as number one thing to watch. But, I'm going to stop giving you a hard time about it because I do think the dollar is really important, and it is sucking the oxygen out of the room for all financial asset prices and commodity prices. It is increasingly become the number one thing to watch. All I can say, though, Patrick, is that this is got to be good for you. The euro going down, because you're a man of spending time in Europe. This is just your summers just keep getting cheaper and cheaper.
Exactly. Hold lots of U.S. dollars and spend it in Europe. It's like winning. I'm winning. Anyway, but let's talk technically. I know this really one smart co-host that one has that says there's no such thing as triple bottoms.
There's not. Oh, yes, you're right. You got me. You got me there. There's 3. So I hope, you know what? I got to be bearish. I got to say it's going to plunge to new lows.
No, you can't agree with me. Shush.
No,
All right,
because
like, don't butcher this.
No, because I'm intellectually honest about the no such thing as triple bottoms. So I won't go and say no such thing as triple bottoms except when it's something I like. There's no such thing as triple bottoms.
I switched it to a monthly chart.
Yeah.
Went back 2 decades, back to 2000 to 2002. We are at a 1-decade low with a no such thing as a triple bottom.
Yeah. Jeez.
If this gives out, not only is parity in sight, but I mean, can you imagine we go to 2000, 2002 lows? That's like 85 cents.
We're not going there. That's what I love to hear. That's what.
No, I'm not
listen.
forecasting that. But
Yeah.
Is there any denying that there is no support technically to this chart on this monthly chart after we give out this low?
I'm not going to disagree with you. And Patrick, I have alluded to one of our previous guests before that is wisely told me to be short euro, short yen, and I watched him, and he's sticking with it. Yeah. And he wants to remain anonymous, but I did ask him. I said, "Can you tell me when you're getting to the point where you're no longer as bullish on the USD?" And he says to me, "When I see buy recommendations on the US dollar, which I have yet to see." And
True.
You know, like he might be right. And I was hoping, little part of me was hoping when I sent the email, I was like, I'm hoping he's telling me he's already covered some. But he hasn't, and I don't know. I'm not going to fight you. I'm not going to fight you.
But you know what? But I'll tell you, not once, I can't say that. If we do break these lows, because this is a major support, and it has not broken. This is why it's the top 3, number 1 thing to watch. Will the support line hold? And so if it doesn't hold, we will see the euro edging toward parity. And tell me that not every news agency in the world is going to be headlining, the U.S. dollar approaching parity to euro headline.
Completely agree. And that's when I'm going to buy it. That's my point. When all of a sudden, when technically it looks the best, when everyone's talking about it, and when we get the what do you guys call that? The turtle head.
It ain't going to have a turtle head down towards parity. That's a downtrend, dude.
No. But if we get a dip down below and then it pops right back up, which is what I think.
Okay. You know what? I am so going to be betting the Euro USD in our weekly bets. And I'm just going to milk you. This is going to be like taking candy from a baby.
I'm not going to disagree with you right now. I'm not going to disagree with you right now. You got to wait for it to break and for everyone to get bearish, and then I'll take the other side of your trade.
All right.
The real question is like, how much does it run if it breaks? Yeah. I think it runs 3 points, 3 cents real quick, and then that's the point. I don't know. That's just me. You know me. I love fading the kind of the hysteria.
Yeah, but it will bounce, and you're going to look right when it goes down to 101 and bounces back to 103, and you're going to be like doing a little parade for your 200 pips.
I never do parades, and don't sound like somebody else that we know that's accusing me of doing like a being right just for a week. Anyways, all right, let's go to the talking charts. What do you got?
Yeah, well, listen, let's just talk about this S&P for a moment and highlight simply lower highs, lower lows. I still see that there's an immediate downside risk towards 34 to 3,500. Now, to me, this very level we're trading, the actual lows from yesterday and today, around 37.50 for rounding purposes, is a short-term fib support line. And until we break below it, then the floodgate hasn't opened. But if, for whatever reason, over the long weekend or going into this close, we have anything that hammers a sell candle, the downside targets to me are still a solid 300 plus S&P points down. And that's the most immediate risk. And just continues to be amazing how global equity is weak. And the NASDAQ rolled right back down to its low. The Russell 2000, no matter how much much value and cheapness there is. This chart is awful. And then you go to global equity, Nikkei rolled right over. I mean, it's debauching its currency. Or botching up its currency and basically
debauching. You're giving me a hard time of mythology or whatever I said.
Yeah, I'm fine. I'm they're botching up their currency and
they're debauching it.
They're debauching or botching. Which one?
I don't know.
I'm embarrassing myself. Whatever. Whatever. Just make fun of me. But the point is that not even a weakening currency is propping up this chart. Like, it looks like the Nikkei could easily work its way back to March lows. Euro stock rolling right over, looking like it's about to break to a fresh new low. Emerging markets still in an ugly downtrend. If that dollar breaks out, like the euro breaks down, what more of a catalyst do you need for another full leg lower in emerging markets? Canadian market, in spite of all the energy working, this is a brutal chart, just nonstop downtrend. Every market except for one, China. But China was going through a pretty tough time, and things are slowly shifting there. But the thing is that can China's market really run when the rest of the world is the developed markets are just getting their asses handed to it? I'm not sure.
I don't know. That Chinese market is not a real market in that it's set politically, and I know a lot of markets are influenced politically, but it's even more so than most.
Yeah. Australian market, by the way, had an awful June, rolled right over off of a weak bounce, looks awful. Brazilian market looks awful. Did you see that massive downtrend in the South Korean index? The Kospi just keeps eating it. We are in a massive global bear market. And, you can't isolate the S&P 500 from this. We're basically, the central banks of the world are tightening and equities are eating it everywhere. And this, to me, just does not bode well for U.S. equity. I think that that vulnerability of breakdown is still very real.
Do you think that we could have the possibility? Well, I shouldn't ask you what you think we could have it. What do you think the odds are that we have like a long-term capital summer? And if you remember back in '98, we had this terrible summer where it was just illiquid and everything went no bid, and it happened in a vacuum almost. Are you worried about that?
You know what? I almost welcome anything that is different than this methodical bleed, because it's so hard to have any justifiable action point to do something different other than to sit back and watch this. It's like a slow bleed.
Yeah, I hear you. I hate the grind hires. And so you're saying the grind lower is just as bad.
It's just
you want some action. So if you're saying if we're going to go there, let's just get it over with.
That was actually the gift of March 2020, is the fact that it happened all in 1 month. It was just like ripping off a Band-Aid. It just like, boom, down 30%. There it is. And it was buyable, and it turned around, and everything was over. At least it was like a capitulation to it. We're down, though. This is some of the greatest wealth destruction in history, and it's just methodically, slowly happening. It's crazy, and it's hard to make a turn call on this market, right?
Yeah, and you know what? When you show the charts, it becomes even more clear. You're absolutely right. Everything looks like death. Like it looks like what's your technical term? The chart looks like shit.
Yes, that's the official.
That's the official market analysis.
Yes, the market looks like shit. All right, so the crude oil may be the only market that still has a chance. It's still the only market that is making higher lows in the sequence. Now, we did reject off the 111, 113 fib zone, and it dipped a little bit. But when you have a kind of a headline, the way we did the other day, turn oil down, I welcome those, because it actually is a tell. If in the coming 2 or 3 trading sessions, crude oil works its way all the way back to 113, brushing off any negativity in the oil market, then this thing is still in full bull mode. Like if it can brush off bad news, reverse, and buy on dip traders just trade it right back up, this may be the only market that is demonstrating outright bullish characteristics. And therefore probably should have been in our top 3 things to watch. But for me, will we see crude oil work its way back to the highs from this week, around that 111, 113 zone? And more importantly, will we see that the bull trend remains intact? I think it's a very important thing to watch. The other noteworthy thing is just the bleeding in precious metals. But I'm not even going to show the gold chart. Silver is the one that ate it today. It was down almost at $19 at one point. Just a heavy breakdown. And when you really stop and look at it on a weekly chart, we had an extended sideways consolidation the way we did in copper. And this breakdown in the last couple weeks has definitively broken major support lines. And it has really opened the window that we could see silver work its way right back down into the 2018 to 2020 trade range. We could see something in the mid-teens. At least there's nothing stopping it at this moment when it breaks through major support lines like this. Now, down the road, that will probably be an epic buying opportunity. But there's no denying that on the short term, this is ugly.
Yeah. No, you're looking at. I'm looking at the charts. Hard to argue that. And copper is even worse.
Copper is even worse. So this is the weekly chart, but there was that 18-month trade range right in there, and just the last week it started, and just bam, started to get hammered. At this stage, we may very well see copper get right down to under 350. We could see 3 to 350 zone being tested at some stage. All of these, I remain, first of all, a commodity bull in the secular sense. I think that there's something happening that isn't going away. And so when we see major bull trends like this correcting this deep and of this magnitude, then to me, it is the place I'm focusing on for the buy on dip, even though I'm not doing the buying yet. Because in the end, there's still primary bull trends. And this is just a very deep correction of primary bull trends. That's much better than some of these tech stocks that are down 70, 80%. There is no correction of a bull trend. That is an outright bear market, right? And so even though these commodity charts are just awful, and they might even go much lower from here. Not much lower, but definitely may just keep working lower in the coming weeks and months. It is definitely the place where the next buy on dip is in my mind.
Yeah, one of the things I worry about is like if you look at copper and look at the action, it looked great until what, like 3 months ago, 2.5 months ago?
Yeah.
And you could have argued at that point it was quite bullish. And I worry about, is crude oil just going to do the same? Is it going to seem bullish until finally it gets too much and it rolls over?
Yeah, but the chart don't lie. I mean, once it breaks,
yeah.
right? Like the point is that crude oil has not broken.
Yeah,
and
listen, you don't have to get me wrong. I'm with you. As you know, I'm an energy bull, and I've re-entered the crude oil and the energy markets on the long side. I just worry about it. I see these charts of all these commodities breaking down, and I think, oh, geez, maybe we're gonna have to keep tightening until crude breaks, and then that'll be the point where you can buy them again. I don't know. Just throwing that out there.
Yeah, we'll see. I wanted to just obviously we touched on 10-year Treasury yields at the very start. I wanted to just talk about this junk, and I know you always push back on me in this. At least when we talked earlier, but this is a brutal downtrend. But I wanted to just look at these credit spreads, and so what I have is both just a high yield broad basket as well as the triple C's, and the triple C's are now at 12%, and the broad junk basket is close to 6% on those credit spreads. We haven't seen these kind of numbers in a while. I mean, we did see it during the March drop, and we did see it during the 2016 period where these credit spreads. Here, I'll just take the triple C's off, but we saw credit spreads work their way up towards 8 to 10%. And at this moment, I don't see how we don't hit there. I mean, the conditions, in my view, are way worse in 2016 or 2020. And so why shouldn't we be trading at similar credit spreads? I think that this continues to worsen, and this is maybe where some of the stress points can emerge. Right now, nobody has been talking about how bad conditions are in the junk bond markets, but what if they do get so bad that no company can raise and they're paying ridiculous amounts? And what if this is the trickle-on effect that really starts to break the equity markets? You don't think there's any concerns for you on that?
No, I do think there's concerns, and I do look at the action, and I am worried about it. And you're right to highlight it because it is getting to points where and it's not just us that's going to worry about it. It's going to be the Federal Reserve that worries about it, because it's going to get to the point where not as good borrowers aren't going to be able to raise money. You've highlighted that, and the reality is that if you look at the corporate high yield issuance, and I was just pulling this up this morning, we're running way below the levels of the past 5 years. Way below, meaning that it's already dried up. Now, maybe they don't need it as much. Maybe there's a function of that. But the reality is that they're not raising money, and if they try to, they might have troubles, especially in this thin summer environment. So I'm with you that I'm worried about it. It's hit a level where I'm worried about it. Now, the flip side to that is that really smart people like Howard Marks from Oaktree. He just recently started pulling out some blue tickets. Meaning he's buying down here, and I get it. He's big. He needs to buy
on the way down.
Yeah, he needs to buy on the way down. He's not going to be the absolute bottom, and he'll welcome lower prices because he's got more to put to work. But I don't know, Patrick. I don't know what to say in that. I don't know if I would expect it to get worse just because it has to get worse. Like I heard your comment. You said, why shouldn't this be like 2020? Why should this be like 2016? And my pushback to that would be that the fundamental economic activity or the environment is much different, and that it's better.
Oh my God! I just puked in my mouth when you just said that.
I know. I'll take the other side of that trade. I think that the economy is better than people expect. And
See, the problem is we both agree on a couple things like crude oil, which means everyone should get out of crude. And because we don't agree on junk, then we know that there's a trend move coming here for sure. Listen, read the tea leaves of the Huddle crude.
That's correct. And you know what? It'll be the one. Watch this be the one triple bottom that holds, because I'm poo-pooing the idea that it'll hold on euro dollar. That'll be the other signal that people should take.
Yeah, buy the euro right now.
Buy the euro right now
because we are so sure
that the triple bottoms don't hold. Yeah, you're absolutely right. It's going to be the one. It's going to be the one that shows me that triple bottoms, there are such a thing. It'll be like the unicorn. All right. Is that it?
Anyway, let's get to the skin in the game, bud.
Okay.
Now we're gonna have something different, but let's start off by just quick. 2-3 weeks ago, we made an agreement to settle this debt up on this bet for a steak dinner, buddy.
And I lost. Gosh.
In a spectacular way.
Spectacular way.
You didn't even have a chance. Like this thing just it blew through 127 and not even toyed with your number.
It just made a fool of me.
It made a fool of you.
Yeah, it did.
And I'm good. Thank you for the steak dinner. I'm looking forward to.
Well, I'm going to come to Portugal and settle it up there with you because it costs like a tenth of what it costs in Canada.
No guff. There you go. Anyway, so
let me tell people.
So by the way,
sorry,
just quickly, just to tell everyone what the bet was, we were about doing a relative outperformance of the consumer staples versus Kevin's darling of home builders, and the staples held up way better throughout the last 2-3 weeks. All right, so Kevin, this is the part where you go.
Okay, so skin in the game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants, okay? Every wager needs to settle by next episode, but listen up, folks. We're going to change the rules of the game. We are going to play a match, and the match is going to go to 100 points, okay? The loser of the match will take out 3 lucky or unlucky, depending on how you think about things, Market Huddle listeners for a dinner where they can grill him why he had so many bad calls. Okay. Each week,
but both of us will be there.
that's right. Unless people don't want the winner to be there because he'll be gloating so badly. Each week, Patrick and Kevin will be able to bet anywhere from 1 to 10 points on each wager. Once someone hits 100, they will win the match, and the loser needs to start figuring out restaurant reservations. Lena was going to be in charge of somehow picking 3 Market Huddle listeners randomly. We'll figure out those details as we get closer. Yeah. But the pool will definitely include those submitting questions for No Stupid Questions and those sending in side effects for us. Okay? Yeah. So you got it, Patrick. We're going to 100 points. You can bet.
No, but there's no we're not netting though, right? We're both accumulating points.
Yeah, so it's going to be like 52 to 40.
Because there's no netting of trades.
There's no netting of trades. Okay, so you start with your bet.
Oh, so it's the same concept, right?
Yeah, the winner keeps going. So you do the bet, and then I have to choose, and then we'll do the wager. We'll figure out how much we're betting.
All right. Let's do prevailing trends versus bounces. Let's work with copper.
Oh, okay.
All right, and but we got to give a little bit of leeway. Over under 375 by next Friday.
And what are we right now?
We're 360.
Oh, that's a good bet. That's a good bet. Oh, you bugger. I'm going to take under. I know you wanted me to take over. I'm going to take under.
Okay. You're taking under. How many points?
Okay, so we start with the betting of the 1. Okay, and I'll raise it to 3. And so you can call.
Yeah, I'm calling you on 3. Like I don't want to do more than 3 points.
Okay, so the first one is 375 on copper. What month are we trading? Because I don't want to get screwed on the roll here.
I had the continuous contract up. Let me just
let's make sure. But we'll figure it out. But 375.
Oh no, hold on. Let me just actually get the contract up. Hold on a second.
Here he goes.
So you want to do the July? We'll do the August.
Okay, so what?
The August is at 361.
Okay, so that's fine. So we're gonna do the August, and I'm taking under on August copper 375 when we settle next Friday, and it will be for 3 points to start our new game off.
All right, there you go. All right. It's time to move on to no stupid questions, just stupid answers, and Lena's going to help us with those. Give us how you doing, Lena?
I'm good.
Save
I was
us,
just
please.
trying to
I'm
figure
struggling
out
here.
who's going to keep the points for the skin in the game. Sounds like something I got to do
I guess
every
you've been
week.
voluntold. Just been.
I didn't know about it.
No, but Lena, know what you can do is just on that screen. Just put the score at the very bottom, and we'll just update the screen so there's a running number on there.
Don't worry, if Patrick starts waiting, he'll be tweeting out the score every week.
Oh my God, it will
true.
not. I
That is
will
true.
not. All right, here we go.
Anyways, moving into the questions for this week. Hey team, I'm newer to shorting and have noticed I just get cash in my account. Is there a reason why I shouldn't just short a bunch of iVol because it's not very volatile, and then use the proceeds to load up long on a pipeline that pays a 10% dividend? Would iVol's dividend be subtracted from my account monthly? I wouldn't think so. Maybe some sort of margin thing comes into play. Free money? Free lunch? Should I start a hedge fund called the Martingale?
Do you want to do this one or me, Patrick?
I'll let you, but I mean, overall, the observation I would make is that while you're short, it does cost margin to carry a short, and while the cash does appear in the account, and you're playing the relative carry, and you got a positive carry between the two yields. The thing is that you still have risk because the two are moving, and they may not be opposite correlated, which means that you may expose yourself to some substantial volatility. I don't know. Do you have something to add to that?
Well, okay. So there's a couple of questions that he or she had in here. First of all, would the iVol's dividend be subtracted from my account And yes, they would. You would owe, if you short security, then you owe the dividends. And then the other thing is, we are not tax accountants, and you should go talk to your own tax accountant, but there are differences in terms of being short a dividend versus long a dividend, depending on what country you're in. And then finally, there's also another thing to think about, which is the cost of carry in terms of borrowing that security. So that's just in terms of the actual fees and the issuance on what you'll be paying for it. And then, as Patrick rightly points out, you are going to be experiencing the risk associated with being short one versus the other. And the thing about iVol that you need to realize is that it has tips in there, and it's 5-year tips, but in some ways that's gotten crushed because of the reality is that rates have gone along higher. And then it's also long some curve steepening options, and the curve is flattened. So the performance of iVol has been pretty anemic lately, and it might look like that there's no chance that that'll ever take off and outperform your dividend paying pipeline. The reality is that there is a potential for that to go much higher, and there's way more risk in that trade than might appear at kind of first blush.
But there's a lot of people that try to do the carry trades where they're short something long another and think that they've done a good job of hedging out most of the risk in doing so. But the market has this amazing ability to play the role of the great humiliator, and that's that one thing you didn't take into consideration, that the market somehow has a way of sneaking in that dagger between the plates of the armor and getting you. Like it's
I like that.
It's
right into the face, that part in the face.
Yeah.
Where you can see.
All right. The point is that it ain't no free lunch. That is so, and it ain't no free money. All right,
That's
let's
some
go
more
to the next
wisdom from Patrick, the wise. Okay.
Hello, sexy market musers. I have a noob question. I think this
That's definitely
confusing
towards
it for
you.
a different podcast.
No, I'm good.
I want to buy the front and back of the curve 2s and 30s. I think that makes the most sense if you think a recession is coming and the Fed will blink and go back to zero rates. Me thinks all the bond vol will be in the belly and the ends will just beeline towards zero. But what is this trade called? What are the implications? What am I actually doing? It seems correct to me, but I also have no idea WTF I'm doing in the bond market. I am looking at government ETF, which mirrors the 10-year. Its dividend payment is 1.18%, but the 10-year is at 3.2. Why the difference? Do they just love fleecing retail traders like me who can't afford to buy ZN? Bastards, thank you so much, and big kisses.
What is the government ETF? I actually don't know that one. Do you know what,
IEF?
Patrick?
IEF.
GOVT ETF, which mirrors the 10-year.
Because the IEF is the 7 to 10 year iShare unit. That's the one I would usually look at. Let me just look at the GOVT.
Again, you know what? I'll start with this. I'll repeat the wisdom of my partner here and say there is no free lunch, and there is especially no free lunch in the treasury market where these things get arbed the shit out of by people that are really smart at banks and hedge funds and using tons of leverage. So then the question is there a trade to be had by buying the extreme front and the extreme end of it, like almost doing the barbell approach, meaning you buy and staying out of the middle of it? First of all, this listeners correctly realize that the 2-year is all going to depend on what the Federal Reserve does. And then the 30-year is almost the opposite. The Federal Reserve barely affects that, and it has to do with pension flows and all that sort of stuff. I don't like this trade because, to me, I still think that the 30-year has the potential to reprice much higher in yield as people realize that inflation is, although it is going to come down in the coming year or quarters, that the long term we're going to see more and more inflation over the period that we used to be 2% was a ceiling. I think it's going to be a floor, and I think that the long end's going to reprice higher. So I don't like it, but it's kind of overly complicated. If you think that we're heading into a recession and you think that the Federal Reserve is going to cut rates. It's just a question of where you want to be on the curve, how you're going to want to work it, and if this
like something like the IVOL builds in the steepener kicker in there.
Yeah, but the trouble is that there's also some tips in there, so it ends up being more complicated.
Of course,
trades.
but I mean, but is it less complicated than what this listener is trying to do with using a bunch of ETFs that are not even paying yields that are similar, right?
Yeah, I don't even know what the GOVT ETF does. I don't know about the 10 years 320.
Yeah, but both that one and the IEF are at least on the system here showing 115 yields. So they're nowhere near the yields that are actually being advertised.
The one thing I will tell everyone, there is very little free money in arbitraging or doing this, and what you should do if you want to actually trade in this, you need to keep your costs down, so therefore you should be going and learning about trading futures, because those are the most
euro dollars more importantly, because like otherwise you have to deal with all the different sizing issues of trying to pair the 2s and 30s.
So although it's not for everyone, and for those who are just investing in it, it's not something that you should be doing because it's more of a trade. But for those traders that are interested in playing in the fixed income markets, I would suggest you go and read some books and go and have a look and maybe open up a paper trading account and start looking at how those futures work. And one of the things I'll tell lots of people is that bonds aren't as complicated as everyone thinks. That you just have to get in, you have to roll up your sleeves, and you have to figure out how they move and what's going to happen. And for those that are interested, our buddy Morris Sachs, which I believe we're going to have a question that refers to him in the next one, he just recently talked about the fact that it's people think that they're way more complicated than they are, and the reality is that bonds are actually more simple in a lot of ways than stocks. All right, so let's go to the next. Speaking of Morris, let's go to the next question.
Hi, Lena, Patrick, and Kevin. I have a no stupid question for Kevin. When we met for coffee in February 2020, aside from Winnipegger things, we talked about MMT, Japan's CB, and their bonds. You asked me if I thought Japan's CB has a limit in their ability to buy bonds, or any CB that's buying bonds in their own currency for that matter. I said no, they can buy as much as they want, list MMT reasons here. You agreed. Fast forward 2 years, patiently or painfully, listening to Morris and Liam's final June episode, Morris is giving you a hard time for your short JGB's position. WTF? I'm curious to know why, at least temporarily, you changed your view. Love the show. Hope you all have a great summer. P.S. Lena, you need to initiate an intervention with Morris and Liam. What a shit show lately. Fish and now 90s internet issues. Maybe Morris's gold position is so bad he's had to downgrade to dial-up.
I can just picture Morris with the dial-up, the IOL. Or AOL, sorry.
My God.
You got mail, Morris. Okay, let's go through this and let's talk about why I think that JGBs might be a short. And although I agree that any government can buy as many bonds as they need to, there are environments where I believe that too much fiscal has been done and the economy actually gets going, and unless the government pulls back on the fiscal, the only other alternative is for the central bank to offset it with tighter monetary policy, which is exactly what we're seeing here in the U.S. The U.S., we're seeing that the government did too much fiscal, and yes, you can blame it on you can blame the inflation partly on supply issues and all that. Although I admit that the supply issues have had an effect, I, at the end of the day, believe that the government did too much fiscal. They should admit it, and they should pull back on the amount that they spend. The reason that I'm shorting JGBs is because I believe that all of central banks are forced to right now offset the great amount of fiscal in the entire system with higher rates, and I think it's only a matter of time until Japan has to admit that as well, because they will, if they don't, we're going to see the Japanese yen continue to go down, and they're eventually going to get the inflation that everyone else is seeing. It's obviously more complicated than that, but I I think that part of the problem with MMT is that they assume that we operate in a vacuum and that there's no currency issues and there's no problems with exchange rates moving precipitously, which is what I think we're seeing right now. Anyways, that's my kind of feeling
There you
with
go.
that.
All right. And the final question, Lena?
We have one more. I think this is more of a request, but hello, Kevin, Patrick, and Lena. I love your unique Market Huddle show. So refreshing to mix valuable knowledge and humor. Great job, guys. I understand the
Who they
prairie
call him
dog
funny? Not me.
I understand the prairie dog and turtlehead, but in this crazy world and markets, we need a pattern for indiscriminate destruction. I propose the honey badger. I believe you can create a pattern for the honey badger.
Well, we have a Muir formation and a pelican formation, so why not have a honey badger formation? But, Kev, the honey badger is one badass animal, and it just doesn't give a shit. And I think at some point there will be a pattern that will fit it, but I don't think we can force this one, right?
Yeah.
This is
The patterns have to come organically.
yeah,
And they will come, and we will keep a lookout for the honey badger formation. And for those who don't know about the honey badger, just Google honey badger Randall or something. Randall narrates the honey badger. It is a hilarious YouTube video that will have you in stitches. And actually, there's an even better one, Patrick, that not many people talk about. There was a South African fellow that had kind of like a hobby zoo or something and kept all these animals. And he had a badger that he tried to keep in his own little pen. And it goes through the stuff this guy did. He took trees that are logs and he moved them to the side. And then at one point there was a female honey badger and he was working real hard to get out when the female honey badger was in the other cage. Anyways, you should Google that one as well, because that is just 5 minutes of hilarity as this honey badger just outwits this guy.
But as an investor, though, if we were to stereotype a honey badger, would Kuppy not fit the bill for a honey badger? He just doesn't give a shit. He just does whatever he wants, and everything just bounces off, and he just doesn't give a shit, right?
It's true.
Anyway,
Harris honey badger Kupperman. I like it. Okay, there we go.
All right. Anyway, Lena, where can they submit their questions?
If you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at the Market Huddle, and you know where you can find us. Patrick, where can they find you?
You can find me on Twitter at Patrick Seresna, or you can follow me at bigpicturetrading.com. And Kev, where can they find you in that amazing newsletter you write that I don't read?
That's so amazing you miss it. I am on Twitter at Kevin Muir, and you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
All right, so let's rate the beer. I only remember, I'll go first because it was obviously foaming like crazy when I was shotgunning the exploded beer. And so I only have something, but I do remember that saying, well, this is a great summer drinking beer. And so it was a nice warm day at the same time. The beer was unfortunately warm. I didn't have a chance to chill it. But you know what? That's if you're going to drink a warm beer, you might as well shotgun it. So it was a perfect combination. You know what? For a summer-rated drinking beer, I'm going to give it a 7.8.
Maybe you should shotgun more beers.
Maybe I should.
Kaylina, what do you think about it?
I was hoping it would be a little bit more fruity.
Okay.
Because it's a strawberry beer, and I was like, oh, maybe it'll be, like we like that banana beer. So I was like, oh, maybe it'll be kind of like that.
It's like the opposite of your dates. Not that she dates anymore, but anyways, go on.
It's good. It's just I think I was expecting it to be a little bit sweeter, but it's good. I would give it a 7.6.
So I think, given that it's a strawberry beer, which just sounds terrible, and it's a quality beer, I'm giving it 8.1.
Oh, wow.
It's surprisingly good because the strawberry is very subtle.
Yeah.
And I love it. I'm a fan.
This is for refined palates.
That's right.
Oh, refined
Refined
palates.
palate.
Now, speaking of refined palates, we got to get ourselves onto this beer that's making its way in. Is it Singapore or Hong Kong?
Yeah, I think you said Singapore.
Yeah. Let's
Come
not.
on, we got to drink this.
Let's
we got to
not.
figure this out. Do you?
You drink
Okay,
it
fine.
first. We'll
No,
see
no.
what happens to you
So,
after 2
for those who
weeks.
don't know
We'll
what I'm
drink
talking
it.
about, I had a good buddy of mine sent me a Bloomberg article, and the Bloomberg article was about a beer, and the beer is made out of toilet water, and like I know
Recycled.
that
Recycled.
Recy-
sewage water.
recycled,
Yeah.
it's recycled toilet water. Listen, it's gonna be a complete marketing gimmick, or it's gonna taste like shit. Literally,
No pun intended.
yeah.
Like,
So what is it called here? New Brew. Okay, it's Singapore. It's a Singapore blonde ale. It's made with recycled sewage. They didn't say sewage.
so if any of our
water. They said
listeners-
sewage. So maybe we're talking solids here.
Oh God! Oh no! Chunky
so-
beer, no.
any of our listeners that have access to getting
Yeah.
this beer and are willing to take the bold step of sending it to
well,
us,
just let us know. Reach out.
we will.
Yeah,
we
we'll pay
would
for it.
be-
We'll pay for all the shipping.
we would
and-
be
and stuff.
grateful.
You just reach out.
and we would be
Yeah.
grateful for the assistance. I think it would make a
Yeah.
great episode.
Well, I love the quote.
Maybe not a great
I
beer, but a
seriously
great.
couldn't tell this was made of toilet water. That was a quote. Okay, well, that's going to be like the name of the episode. That one. I seriously couldn't taste this. Tasted like toilet water. All right. Okay, I got something to say. I went to see Top Gun, and I think that everyone went and got me too excited about it, and it didn't live
Oh,
up to
it
my
flopped for you?
God, you know what? It's just everyone told me how good it was, and that's why the problem. It set the bar too high. It didn't meet expectations. It was fully priced in.
Yeah, it was.
Have you
baked
seen
into the
it
cake.
yet, Lena?
No, I have not.
My like my
Either have
daughter
I.
was even my
I'm
daughter was telling
horrible.
me she hated the first one. Was telling me this is how good it was and like how it's getting 97 tomatoes. And see, that was the problem when I heard 97 tomatoes. That's setting the bar really high for me. And it was, listen, it's a really good movie, and I'm not going to take anything away from it, but it's exactly what you'd expect. They just reboot everything, like, they just redid the whole movie in 2020 or whatever.
Who's
Yeah.
submitting these ratings on Rotten Tomatoes? That
I think
gives
it's
movies
everybody.
ratings? So
There's-
it's just like a general consensus sort of
Yeah.
thing. People just rate it, like
Yeah.
they watch it, they just go rate it.
Yeah.
So we have no idea who's on the other end rating these movies.
No, but it's the group. It's the wisdom of crowds. Right?
Yeah.
It's literally got a 99 audience score. Like, this is the first time that I'm like, that's too high.
Yeah, you know what? The crowd got Bitcoin right at the top. So it must get the score of Top Gun.
Well, and the thing about it is, so this one
Consensus.
gets.
Does that work?
I don't know, Patrick. Don't get me in trouble with the Bitcoiners. Okay, this one gets 99 tomatoes, and I'm going to do a spread trade here because let's look at this. And then the original one gets 58 tomatoes. Okay,
What?
I'm a seller. Yeah, I'm a seller of that.
On the
I'm
spread.
a seller on the spread. That's where. Oh no, I'm wrong. That was the tomato for the critics. Is 83 on the audience score. That makes more sense. But I'm still a seller. I think that the spread should be closer to even. It's no better and it's no worse than the last one.
It's just a continuous
Exactly.
story,
It's just
right?
a
It's
new
not like
version. It's just a new version. And the guy from Divergent that has the most punchable face in Hollywood, he actually did a pretty good job.
Why does he have the most punchable?
I
face
don't know.
in
He's just
Hollywood?
kind of a punchable guy. He's kind of a knob when you see him interviewed and stuff. I'm not making that up. Someone else said that. And I was like, yeah, he really
Are we
is
talking
kind of-
about? Wait, Miles Teller? Is that
Is
what
that
we're
his
talking
name?
about?
Yeah, I think so.
The young guy, like the
Miles Teller. Let me see if
Yeah,
that's
right.
him.
Miles Teller.
Yeah.
He was in
Yeah, that's him.
Whiplash.
Yeah, that's him. Okay, now, here's another thing I didn't realize, Lena. Did you get around to watching The Staircase?
Oh no, no.
oh,
I
you still
I
haven't
have
watched
not.
it, so we can't talk about the scene that was
No,
weird.
I
Okay.
have to watch it again.
Okay, but what's interesting, I didn't know this. One of the kids from The Staircase is Schwarzenegger and Maria Schreier? I can't remember.
Schreiber?
Schreiber.
Shriver? Is that right? I don't know.
Yeah, it's their son. And he's actually seems like I saw him in an interview. He seems like a really nice kid. I don't even know his name. What's his name? Let's just Schwarzenegger's kid.
Well, accidents happen.
Oh my god.
Maybe are you trying to say it's not Arnold's?
No, well,
Patrick Schwarzenegger.
Yeah, and he's a really nice. I really like him.
He was born in 93.
youngin.
Anyways, I like this kid. This is my new kid that I like him. He's like, I saw him interviewed. He's very humble and he seems like a really nice kid. Very unusual, like considering what in the environment he grew up in. Although I guess maybe you could argue Arnold's not as bad. And Arnold does some stuff that you see him and you're like, oh, he's actually talking some sense and seeming like a good guy. So maybe
I like Arnold.
Yeah, maybe I'm being wrong. But anyways, what else do you watch? Anything new and exciting?
I have
No?
actually not watched TV in like a week.
And Patrick's always traveling, so he never.
No, I didn't watch anything.
Yeah, no watching. I mean,
So-
you're busy watching llama chase videos and also honey badger videos, it seems.
Me? Oh, I love
Yeah.
those. And Patrick is a man of the International Man of Mystery.
Oh, it's all good.
He
buddy.
doesn't like me
It's
talking
all
about
good.
it. He
And
doesn't
you know
like-
what?
he doesn't like me
No. But it's
I
all
must
good.
say, well, we'll talk
It's all
about
good.
Portugal a little bit because I loved it, Patrick. I am a huge fan. I completely understand your attraction to it. I did think it was interesting that I left, and then all the ECB and everyone else had their conference in Lisbon.
there.
Yeah, it was actually in Sintra, and I realized that that's why you had to get back because you were needed there.
That's exactly it, right? Like,
I was like, Patrick's like, I got to get back to Lisbon, and it's like, okay, I understand. Patrick he's going to the.
They sent out a pat
did
signal.
you guys go to Ramiro's?
No, what was that? One of the restaurant?
at-
One of your
Oh,
restaurants?
That was the Bourdain recommended seafood.
No, we did
restaurant.
not. I'm
oh,
sorry.
you gotta go.
Was
It's
it that good?
Oh, it's so good.
Yeah.
And it was right near your place.
It's
I was looking for Ronaldo,
No,
by
no,
the
no.
way. I went up to the thing and tried to find him. He wasn't hanging around very much.
yeah, he just walks around the Lisbon streets. That's his thing, right? Like, yeah, I'm just gonna go look for him because he's just waiting right here. You can find just on that main strip. You can find that fat Spider-Man and take a photo with him. That's
Okay, well, anyways, it's been a long show. Happy Canada Day to all of our listeners. We hope you're having a great long weekend. Enjoy it. Hopefully it's good weather wherever you are. And thanks for tuning in, and we'll see you next week.
all right. Take care, everyone. Thanks for joining us.